The Fed wants to see real yields higher, really to make sure inflation is down and stays down for a while.
The Fed is hawkish, but they're sort of reiterating a message that the market's already kind of gotten comfortable with.
There are a lot of structural forces at play that are not going to bring us back to 0% or almost no inflation.
They're going to be very careful about signaling that they're ready to pause and cut before they know it's the right time.
What the Fed does matters, and it matters a lot for the global economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Fed Decision Day, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures down 0.4%. TK, Fed Decision Day, tons of economic data and Meta after the close.
Yeah, Matt, you wonder if the Fed had a Facebook page, would they have a better communication policy? I mean, it's a simple...
relationship status.
Yes, exactly. But it's a 3-day marathon. Can we be clear that Jobs Day and the wage dynamic there is really important? Dominic Constant's coming up. He says there's no evidence of a wage price spiral, but that's going to come up today.
Would it make a difference to this Fed today if they had Friday's payrolls data right now?
It would not make a difference in the decision 50 or 25, but it would make a difference in his comments about what we're going to talk to Dr. Constam about, which is the extendedness of all of this.
And the easing of financial conditions that they might have to push back against. The NASDAQ 100 in the month of January, which is gone, just like that, up 10.6%. Lisa, what a rally we've seen.
Which, paired together with the Fed, people aren't listening, right? And this is why I'm actually exhausted in advance for all of the Fed speak that we're about to do for the next however many hours.
14-hour day, that's good to hear.
The reason why, aside from that, it's not about what the Fed says. It's about the data. Stop laughing at me.
Let's carry on, please.
It's about the data. It's about what happens on Friday. It's about what happens with the earnings that we get. Because at this point, the Fed is just following behind the data. They are not out front. And that is the distinction.
What sparked the rally yesterday? The data.
The data.
Softening ECI. Will that continue?
And that's what we may see with the JOLTS data coming up later. We may see that with the ISM, although manufacturing hasn't really been the key indicator. But with the jobs report, to your point, if we get a wage disappointment, a big disappointment, that could potentially change the narrative and, frankly, lean into potential cuts later in the year.
I didn't realize we have JOLTS today. That's a big deal. I mean, I'm sorry.
Sure. ISM as well.
McKee says it's a big... ISM is a John Ferro statistic. McKee's all over JOLTS. And again, that's the kind of data that informs when McKee asks Powell a question and there's this pregnant pause and then he doesn't answer the question. He sort of
can't wait for that.
Around it, you know.
If we put what you said together with what Lisa said, we've got a perfect promo.
It is a
for our coverage
promo.
a little bit later. Chairman Powell not answering questions. Lisa absolutely exhausted with the Fed speak before the Fed decision even comes through. Here's the price action for you as we kick off the month of February. Equity futures negative 0.4% on the S&P 500. Yields come in a couple of basis points on a 10-year, 348.27. And TK, don't forget, in December, really robbing the headlines from Chairman Powell was President Lagarde. It's the ECB tomorrow.
Yes, I strongly agree with that. And to me, it's a radically different story. You can disagree with me, which you usually do, but I don't think you can inflate the two together. And with the ECB, with a war going on, it's about the nominal GDP out there. There's no doubt in America there's a nominal GDP. It may be too much inflation and not enough real growth, but there's a spirit in America that you don't have over in Europe.
Lisa, will Chairman Powell sound like President Lagarde back in December?
Maybe. We'll see. And this is what I am watching, perhaps more than the Fed speak. Just to give you a sense, I'm not bored by everything. In fact, there's so much that's more interesting than the Fed. That is the reason why the Fed speak is perhaps diminished in terms of importance. The ISM manufacturing data coming out at 8:30 a.m. for the month of January. I know that you're looking at that, John. The expectation for a fifth straight monthly sub-50 read on that number really is getting people's attention. The JOLTS data, though, is what I'm looking at for December. Do we see job openings come down? This is a leading indicator for the employment market. How much does it reflect a true softening in a market that has remained robust? To me, this could potentially set the tone and be more market moving than any other data point today. 2 p.m., we do get the FOMC rate decision followed by Jay Powell speaking at 2:30 p.m. for that Fed press conference. Perhaps the Fed speak won't give us as much guidance as our guests, who are actually incredible. And so I'm really looking forward. Our special coverage starts at 1:30 p.m. Richard Clarida, former Fed Vice Chair, Priya Misra, Diane Swank, Greg Davis of of Vanguard, all of them joining us. And then after market, I am watching Meta because Snap earnings were pretty dreadful yesterday in terms of their first potential quarterly decline in advertising revenue for this quarter. How much does Apple's changes to privacy really affect Meta in the same kind of way? Snap shares down more than 15%, John, after those earnings. Does Meta follow along with that, given that so much of their revenue really does derive from the advertisers?
Earnings reports from Snap, Tom. And Lisa, thank you. Do you want the price action, a one-day price action after the last couple of earnings reports from Snap? Down 28% back in October, down 39% back in July. You think there's a theme here?
I'm going to go without a discussion of Snap, of which I have no ability whatsoever. The thing that's changed here is the yield structure has changed. Shanali Basak with Nassim Taleb, he had my quote of 2022, the gravity's return to the system, and these companies without EBITDA, without free cash flow, they're in a whole new world after all.
It's the return of discipline. Dominic Constant joins us now, head of macro strategy at Mizuho Americas. Dom, is this hike today the penultimate hike of this cycle?
Well, it could be. I mean, we're very close, I think, to the Fed finishing. I think the key message, though, is they can't kind of tell you they're about to finish. They're going to obviously give a hawkish message around that. They could either sort of, in the second quarter, declare an outright pause like the Bank of Canada, or they could keep it more uncertain in a way that almost say that, we might be done, but we'll see how it goes. In the end, I think they're going to be done, though, around 5%. So this could be the penultimate hike on the back of that.
Dominic, two ideas here. You made worldwide headlines, I should say, was super restrictive the last time you were on. Is this the Fed nearing or in a super restrictive phase?
Yeah, I mean, they are super restrictive. I mean, it kind of depends on how you look at inflation, and we look at it very carefully in a lot of different ways in terms of the impact of inflation expectations, wage price spirals you mentioned earlier, and dissecting it in terms of demand drivers and supply drivers. And when you sort of dig really deep, I would argue the inflation story is looking very good. It is basically normalizing. We're putting to bed the fears that inflation was in a whole new regime. And when you look at that, then essentially when you measure a monetary policy in terms of restrictiveness, both in terms of real interest rates and financial conditions, there's only one conclusion, and that it is super restrictive. And you mentioned NASDAQ doing well, et cetera, but overall financial conditions are still very restrictive. And there is a danger that as you squeeze out the excess demand and profit margins, you're in a hard landing before you know it. And that's why the Fed has to be quite careful not pushing rates too high.
Dominic, we're going to talk to Richard Clarida, founder of DSGE. We're going to talk about the time continuum on the x-axis. The way I see it, and you mentioned this, is an extended period of rates here or a little bit above versus pushing rates up to a higher rate level. Can extended and can an extended Fed substitute for the migration to a higher rate?
Absolutely. And I think the point is that the idea of the soft landing versus hard landing is like a sequencing. You can basically do the soft landing, keep rates an extended period elevated, but in order to avoid the hard landing, you need to scurry very fast to get back to neutral, which we think, and the Fed certainly still thinks, is around 2.5%. And that's the story for 2024. So the danger is of not doing extended, but just, for example, to keep on raising rates means you just got much more scurrying to do at the end of the day, and with more risk, I would argue, of making a mistake that you can't move fast enough if you're already, at say 6% funds. So it's basically staying around 5, getting to 2.5. That's doable. You do a bunch of 50 basis point cuts in 2024. It's quite aggressive, but they can do that, and that way they avoid the hard landing. This isn't a choice of soft versus hard landing. It's a soft landing until it becomes a hard landing. And that's why the Fed needs to be very alert to that reversal in policy, which we'd expect in 2024. Not this year, but 2024.
Dominic, I'm feeling a little bit philosophical as we talk about Fed communication and the market's response. If the Fed speaks and markets don't respond, did the Fed make noise, right? I mean, basically, if the Fed tries to give guidance, stop laughing at me, tries to give guidance, but the market doesn't sell off, is that actually effective in getting the Fed's, you're still laughing at me, in getting the Fed's message across?
Yeah, I mean, I don't think the Fed needs to get the bond market selling off. I mean, the bond market obviously is looking through all of this and discounting a pretty restrictive policy stance in terms of rates. Obviously, it's the financial conditions side of it. It's basically the dollar and credit spreads and equities. So I think if there's too much of a sort of relief rally in these things, then they can definitely push back and they can definitely sort of try and jawbone financial conditions tighter by introducing this uncertainty around maybe the peak in the funds rate, the uncertainty about how committed they are to actually a pause, and that's very likely they'll do that. I'm not sure they'll do that today. They could hint at that, but it's certainly very likely in Q2 or maybe in the March meeting when to do that. And I think Larry Summers, I mean, he said something sensible over the weekend in terms of maybe the Fed shouldn't. Well, I said that very carefully. Maybe the Fed shouldn't really pre-commit to hikes, and that's really would be an interesting thing if the Fed could perhaps have a bit more uncertainty around their policy going forward, even if they are effectively pausing with the benefit of hindsight.
That's the line in the morning, Dom. Run.
Oh,
just
God,
fantastic. I've got nothing left. I've got nothing left for the rest of the today.
Put it up there. Come on, Amy, give me that banner, please.
Please don't do it.
Summers says,
something sensible.
Good morning, Professor Summers. And we look for the panel in London, Lawrence Summers and Dominic Constant. That'll be a great
He's still
panel.
in bed. Don't worry about it. He's not woken up yet. Dominic Constant of Mizzou Americas. Dom, thank you. That was perfect. Wasn't that perfect? Lisa, you've been spending time in nature. What was that about? All philosophical, in the woods, trees falling, all of that good stuff?
Okay, this is the conundrum that the Fed has. Their messaging depends on the market's response. If the Fed speaks and markets don't respond, did they get their message across? Did they affect the transmission that they were searching for? And it's a legitimate question, which is the reason why there's sort of this gamesmanship going on, this chess game between the Fed and markets right now.
I agree. I think it's actually the question going into this news conference, because we've asked a couple of people already what's important here, the data or what Chairman Powell's got to say. They're choosing the data at the moment, which says something about what they think about what Chairman Powell's got to say.
And perhaps Chairman Powell doesn't care. Perhaps Chairman Powell is saying, look, you guys have it better than I do because you're the, collective minds that are coming together to price out the potential economic trajectory.
That spread's got to reconcile, Tom. How it reconciles is one of the big questions over the next couple of quarters.
I hope to say something sensible in the next 3 hours.
We'll go talk with Summers.
I can't imagine, John, what you're going to say.
Larry Summers actually said something sensible.
And Tom tried to banner it.
Thank you, Tom. Futures down 0.4% on the S&P. Live from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Policymakers at the Federal Reserve are expected to moderate interest rates and increases again today. The Fed is wrapping up its two-day meeting. Chair Jerome Powell is likely to keep further rate hikes on the table, while leaning against bets the central bank will cut later this week. Inflation in the Eurozone, well, that slowed down more than expected in January. Last month's reading came in at 8.5%. That suggests there will be a more heated debate to come at the European Central Bank over how much more interest rates should rise. The UK has been hit by its most severe day of strikes in more than a decade. As many as 475,000 union members are on strike today, closing schools, crippling the nation's rail network. They're demanding pay hikes to offset the cost of living crisis. Investors hurt last week by the malfunction at the New York Stock Exchange are trying to get their money back. But Bloomberg's learned that claims are likely to exceed the liability pool that covers losses. Those losses could total in the millions of dollars. The crisis of confidence plaguing Gautam Adani is getting worse. The stock sell-off triggered by Hindenburg Research's fraud allegations has erased a third of the value of his companies. That's more than $90 billion. The flagship company, Adani Industries, lost as much as 20% today. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Folks, just outside this space, the first piece of the new Hudson Tunnel is being built. It's one of the biggest parts of the Gateway program. Now, let me say this at the outset. This is just the beginning. Americans see these projects popping up across the country, and it sends an important message that we're going to, when we work together, like we did in the bipartisan law and the CHIPS law, there's nothing we can't do.
The President of the United States there. Good morning to you all. The price action this morning looks a little bit like this going into the Federal Reserve decision a little bit later on this afternoon. Equity futures down by 0.4% as we kick off the month of February. I really don't know where the last month went, but it went like this for the Nasdaq. The Nasdaq up big time, up more than 10%. Three things to watch, not just Chairman Powell later, also the economic data later on this morning and some earnings from Meta after the close to kick off things for big tech this week. Look over to Europe, euro-dollar 108.94. We're positive there, a third of 1%. Downside surprise on CPI for the Eurozone going into the ECB, but with a monster asterisk. Where's Germany in all of this? Capital Economics publishing just moments ago, and they said this: January's drop in headline inflation should be taken with a pinch of salt because of a data processing problem meant that the data for Germany had to be estimated and might therefore be unreliable. In any case, they went on to say, Lisa, the key point is that core inflation remained at a record high, so the ECB will remain very hawkish.
To me, that was my takeaway, is that, yes, on the headline number, you did see a deceleration. It came from energy. It came from uncertainty in some of these readings. On the flip side, core inflation, still very hot. And so, therefore, the ECB's narrative really doesn't change.
Expected Tom to go 50 basis points tomorrow.
Is that? I'm not there.
Well, we've had the guy from the ECB.
No,
I think President Lagarde basically
yeah.
told us that herself.
Okay, but what's the damage they do with that? I just don't have a
pricing
nominal
it in.
GDP
But
figure.
here's the thing: the market's already pricing it in. It would be disruptive if they went 25 basis points in a way that they didn't necessarily want.
The big reset yesterday. I mean, you're right, but to me, a big part of this is the GDP numbers came in not as gloomy as the gloom crew.
Sure.
To me, that helps Lagarde with 50.
The green light's on. They're going to go 50. Will they go 50 again after that?
Are you
guidance
flying
seems
over there
to be.
tonight? Are you going to be in the
They
lawn
might
again
be. I don't
Friday?
think I am. I think I've got a long day this afternoon, Tom. But maybe I can make that flight.
I'll take the golf.
Would you like me to skip the Fed? Would you like me to skip the Fed?
Have you ever had a Schaefer's beer?
A Schaefer's beer?
Schaefer.
No.
Then they were bought up by Stroh's.
Okay.
And then PBR, Pepsi Blue Ribbon, took them all out.
I trust we're going somewhere constructive with
We're
this.
going somewhere constructive.
Do you?
What do you do in Washington when you've got to get the two sides together? Anne-Marie Horton knows this because she's a student of history. In June of 2009, it was President Obama, Vice President Biden, Gates of Harvard, and other attendees quaffing beers in the Rose Garden. Maybe we'll see that today with McCarthy and Biden. I mean, there's theater to all this. Anne-Marie, what is the theater today of McCarthy meeting with Biden?
Well, Newt Gingrich called it like a first date. This is the first moment since McCarthy took the speakership that these two men will be sitting down together. And you're not going to get any news on they reached an agreement when it comes to the debt ceiling, which is obviously this debt ceiling is what is hanging over them during this first meeting. But it is a chance for them both to size each other up. So, Tom, you are correct when you say this is really about watching the optics, watching the body language, and seeing the statements that comes out of this meeting.
What is the body language that a really interesting set of the GOP want from their speaker? I think, Anne-Marie, particularly for our international audience, this is a complete mystery. Is McCarthy one of them?
Well, he's not exactly one of them, but what he does need to show is that he can deliver. He had 14 rounds of a chaotic, very dramatic speakership, and he cut some deals with the far right of his party, and he needs to be able to deliver on some of these promises, which is why this is going to be incredibly challenging for him when you have the President of the United States and the Democrats, which still control the Senate, saying that we are happy to look at the budget and talk about potentially some fiscal reform, but we will not do it, and we will not hold that hostage when it comes to the debt ceiling. The Democrats really see this as a two-lane process, and the Republicans are going to see it as one.
President Biden yesterday was talking about Kevin McCarthy at one of the fundraisers, and he said that he was a decent man, but that he had to cater to some, quote, off-the-wall concessions, and then said, look, this is not your father's Republican Party. No, I mean it. This is a different breed of cat. What is the breed of cat in terms of the leadership for this next race that we see?
Well, we do know that we only have one, at the moment, Republican candidate running for 2024, if you're talking about the 2024 presidential election, and that's the former President Trump. But we have reporting from Mario Parker out overnight that Nikki Haley will be announcing her campaign February 15th. So she is the first of her former bosses. We know that there's a few that have insinuated they want to get in the race, but she is the first that is going to make this formal announcement. And, you know, she recently said, and Jonathan brought this up the other day when she was interviewed on Fox News, she said, you have to look at the situation right now, and does the leadership match the current problems? She said she didn't think it did, and that she thinks she could be the one to match the moment. So she's getting in the ring.
Former President Trump also thinks that he's the one to match the moment, but he's not really raising that much money relative to the others. What is the likelihood that he could forge some sort of independent race, which really might be, in some ways, the Democrats' best option?
No, I mean, Trump, if he runs, he's running on the Republican ticket. And while, yes, the fundraising has been lackluster, and the New York Times goes through that data perfectly this morning in terms of sizing him up versus past early days of a presidential race. When you announce you're going to be president, you do this with timing to know you can bring in those campaign dollars. I believe what the Trump campaign is bringing in per day is about $200,000 in their first critical few weeks. Compare that to former Governor Jeb Bush or Hillary Clinton when they got into the race. These were $600,000, $800,000 a day. So Trump at the moment is not bringing in the money. It could show that he is losing a grip on the party, but I don't think this is a moment that you write him off, that he would not be the individual if he was to make it to the top on a Republican ticket, and that he would step aside and run as an independent.
Well, AMH, doesn't the fact that Nikki Haley's getting ready to run really underscore the fact that he is losing grip on the party? This is an individual that pledged not to if Trump made a run.
Yep. April 2021, she said, if my former boss runs, I will not. But Trump recently was talking to South Carolina local television, said that Nikki Haley had called him and he had told her, if your heart's in it, you know, you got to do what your heart wants to do. But Trump hasn't really gone after Nikki Haley just yet. But he has gone after the governor of Florida, Ron DeSantis, especially when it comes to COVID. He said Florida was locked down longer than it should have been, and started attacking him. So I would say that his real concern is if a Governor Ron DeSantis gets in the race. At the moment, it doesn't seem like he's taking aim at Nikki Haley. But also, it's very early on, and this is going to be a wide field. We know that Mike Pompeo might throw his hat in the ring. We know that Mike Pence is looking at a run. I mean, there's a number of individuals who are sizing up whether they are going to make this case for 2024.
All to play for. AMH down in DC, Anne-Marie, thank you, as always. This could be really gripping stuff on the Republican side, Tom. Haley, Pence, DeSantis, Pompeo, Trump.
It ebbs and flows across hundreds of years. The Democratic Party used to be the nuts party. I mean, it goes way back to, I'm thinking Grover Cleveland, 1880.
Are you implying that the other party is now the nuts party?
No, but it ebbs and flows, where the Democrats were total chaos.
What kind of nut?
And then it comes back the other way. And clearly right now the Republicans have the chaos meter. John, what's really important here to bring up, and I know that someone like Anne-Marie Horton was so delicate that she never quaffed a Schaefer's or a Schlitz or a Stroh's or a PBR. My first British beer, Lisa, was John Courage Amber, and I remember tasting it and going, oh, this is what beer actually tastes like.
Actual beer.
Yeah. Is John Courage a fancy brand in England?
I don't think so.
Yeah, I just
is Bud Light a fancy beer in the United States?
No,
is that a big
Course,
one?
Yeah,
that right?
It actually
That's
is.
like
yeah.
legit.
Course 3-2, I think, from
It's
Mr.
definitely, you go into a craft beer place.
What about Natty
Bud
Light? Natty Light, is that legit?
Look, I've got family from Milwaukee, so, you know, this is, Schlitz, and you start going to this. Like, don't, you know.
The day they launched.
I wasn't taking, I'm interested.
What?
I wasn't, you know, I'm not.
No, Bud Light is not a good beer.
It's not a good beer.
It's pretty dreadful.
It's not America's finest.
Please.
It's basically a
in the old days,
low-calorie way to get drunk.
Schlitz of Milwaukee was the real.
That's the real.
It was so good.
So good. Thank you.
The Fed decision just around the corner. Equity's a little softer going into that. Equity futures on the S&P negative by a third of 1%, down 0.2 on the Nasdaq year to date. I know early days to say that, but 1 month 1 month of gains on the Nasdaq and the S&P 500. Pretty phenomenal stuff. The Nasdaq 100 up more than 10%, the S&P 500 up more than 6%. And Tom, maybe that might be a wise decision. Book it in. Take the gains.
Sell. Go to Florida.
In the bond market, 2s, 10s, and 30s. I'll talk about people going to Florida a little bit later in the programme. Some phenomenal numbers. Some phenomenal numbers. Yeah. Your 2-year right now, 419.71 on a 2-year. Compare that to where the Fed's going to be a little bit later. The Fed is going to take rates closer to 5%. That inversion there is worth a longer conversation in just a moment. Your 10-year, 348.46. Yields come in a couple of basis points on a 10-year. Just to round things out in foreign exchange for you, yes, we did have a downside surprise on Eurozone CPI going into the ECB tomorrow. But, and there is a big but, we still don't really know what German inflation was for the previous month, and we've got to wait, I think, until next week to find out where German CPI is. Going into President Lagarde, Tom, we're looking for 50 basis points from the ECB.
And their German manufacturing is flat on its back. Is that the generalization?
We're expecting that to pick up in line with what's developing over in China.
Okay.
That seems to be the bottom line for most people.
Yeah, I mean, it's been an eventful January, to say the least, and we're going to do a lot of theory today. Again, our Fed special leads off with Richard Clarida. What an honor to have the vice chairman with us, but it is about the acuity of market economics, and I think it's just all in all going to be really, really something to focus on. We do that now with Rabila Faruqi joining us, chief U.S. economist, high frequency economics. Rabila, I'm going to cut to the chase. What has changed on your Excel spreadsheet in the last 10 days?
What we've been looking at really is how households are responding, and what we've seen is a pretty substantial deceleration in household spending. That really is driving our GDP estimates, and we expect a pretty big slowdown in the first quarter. But what we are seeing on the other side of it is a labor market that just remains very strong, and fundamentals of the households and household balance sheets are really haven't changed that much.
The broad theme for our listeners and viewers is France, China, on and on. Things are coming in better than expected. Can you say the same about the United States of America?
I can say that about the labor market. I can't say that about what we're seeing in the survey data. I can't say that about what we're seeing in household spending. So, the U.S. economic fundamentals, if you look at the basic, the driver of the U.S. economy is still in pretty good shape. Household balance sheets are healthy. Job growth is still very strong. But, we do think that the effects of, 400 basis points of tightening are going to start filtering through the economy. They're already showing up in manufacturing and housing. I do think that that's going to start filtering through. And we do think that the news on the economy is going to be probably disappointing over the next few months as we see these effects take hold.
With that in mind, Rubila, does the spread between where Fed funds will be after today and where the 2-year is right now, does that spread, that inversion make sense?
We've talked about this before, what the markets are expecting and what the Fed is communicating. They're just not on the same page. It doesn't make sense, but maybe this gets resolved as the Fed continues to deliver on its promise, that the funds rate moves closer to 5%. Maybe at that point, the markets adjust. And then, then you've got the other side of it is the message, the higher for longer message, and whether that resonates with the markets or not. Right now, the markets are pushing back. They've been pushing back for a while. But I do think this will have to get resolved as we move closer to that peak rate and we move beyond that. And the Fed continues to communicate that rates will remain in restricted territory for some time.
That won't be resolved with words today. That will be resolved with actions. That will be resolved with time. So, Rabila, with that in mind, how long do you think that spread between the market and the Fed can persist?
What we've seen is that the market is just not believing what the Fed is saying. So, yeah, I think that can persist until we get to that terminal point. The issue really is, and I think maybe what we should understand is that, the Fed's message today, we expect it to be hawkish from Chair Powell, right? He's going to push back against the rhetoric of the pivot towards easier rates. Maybe what's really more important right now is to see what the Fed and what Fed officials are going to signal in the March dot plot. I know they try to, they don't want to overemphasize the dot plot, but it has been a communications tool, right? So how many, what is that terminal rate in March? And how many, if any, Fed officials expect easier policy, in 2023. So I think those things are going to be important. I don't think the communication is going to change. I don't think the market pushback is going to change. I think it can persist probably until we get to that terminal rate. But we really do need to, the Fed needs to be very careful in its communications. There has been that disconnect because the minute they say that they are going to pause, the market is going to be even more convinced that a pivot to easier policy is imminent.
Which is the reason why this is really a gamesmanship moment between the Fed and the market. So let's talk about the data. We have both Bank of America and Morgan Stanley coming out and saying that jobs have to fall below 100,000 on a monthly basis in terms of job creation before the Fed can feel confident that they're getting to the place that they need to be with respect to slowing the economy. How close to that are we?
We're not close at all. I mean, the U.S. economy is creating jobs at a very rapid pace. We're still seeing extremely strong job demand for workers. That is apparent in the jobless claims numbers. I know we could be talking about the adjustment in job openings, but they are extremely elevated, 1.7 openings to every unemployed person. So, I mean, we're seeing a very, very slow adjustment despite over 400 basis points of tightening. So I don't think this is imminent. Maybe we do get a downside surprise on Friday, but I do think that there is a lot of demand for workers still that needs to be resolved with what we're seeing on the supply side.
So how do you push back against the people in the market who say even without jobs coming down, even without the sort of pain that the Fed has talked about, we're seeing this disinflation that feels sustainable? Some people actually coming out yesterday and saying that if you look at certain metrics, inflation now is too low relative to some of the Fed's metrics. How do you push back against that?
What we're seeing in the inflation numbers, it's, we've adjusted down from that 9% to the 6% range. But where we go from here, I mean, that is what is important, and that is what's going to take some time. And this is in the Fed's estimates. This is in our estimates. We just don't see that adjustment happening. Wage growth is still very, very, very elevated, well above where it needs to be in terms of being consistent with the 2% target. So yes, inflation has adjusted. Where we go from here is important. We just don't see inflation coming back to 2% by the end of the year. We still think we'll be at a 3 handle.
Rubila, do you see any history or at this moment where the chairman in his leadership at the Fed will focus on domestic final sales, which has been a little bit shaky versus the noise around it, trade and inventories as well? Do they look at a diminished domestic final sales?
Oh, absolutely. I think so. And as you mentioned, that has weakened. So I think that is something that we are paying a lot of attention to. I think the Fed is going to be paying a lot of attention to that. It's really that domestic portion, the consumer, that drives this economy. And that is where the uncertainty lies. As I've said before, household balance sheets are healthy, but is the consumer at a tipping point? Are they, experiencing inflation fatigue? What is it? Are we going to see a bounce back? That is something that's, just not clear to us. We do know that the labor market is strong. We know inflation is coming down. We know those pressures are easing. We know wage growth is still elevated. But, how does the consumer respond after experiencing a prolonged period of high prices?
I look, Rubila, into the Fed here today, and we were talking to Dr. Kostom over at Mizuho. And we were talking about the idea of an extended rate versus a higher rate. Can they get the same impact of a higher rate by just extending the level near 5%?
I think that is the challenge. I think they have to get to that level. I think they have to stay at that level. This is what they have been communicating. I do think that this is doable. I do think that the U.S. economy can avoid recession. As I said, the fundamentals of the U.S. economy to us suggest that growth can actually remain positive this year. So I do think that they can get there. They can keep restrictive until, we see that improvement in inflation that we want to see.
We will see. Rubila Farooqi there of High Frequency Economics. We're not going to resolve this debate today, Tom. Not in this news conference. You may get some volatility. You might get some pushback from Chairman Powell. I've got no idea. People anticipate you will get that. But ultimately, that debate between this market and this Federal Reserve will be resolved by data, action and time. and you've certainly not got enough of that just yet.
Well, I'd say the ex-post data, and of course we know what that's been like the last couple of days, see the equity markets. But I do agree that his major force today is to be first, do no harm. There's no question about it. He's got to get out to March 22. You know, you look at the scope of the year, and as you say, the January blur. How do we mentally get to September 20th right now? Nobody has a clue.
Well, I think you've picked the right date around Jackson Hole. You push out several months. You start to wonder. The big what if this year, Lisa, has to be what if inflation gets down to 4 and then stays there, and then we've got a problem.
And then we have a political issue as well, especially if you start to see a bit of more pain bleed into markets, because right now we're not seeing it, right? So it's easy to theorize about what happens when we get to that place.
She always goes back to pain in the market.
Pain.
We just had the mother of all
Hey,
Januaries.
let's be clear.
Since time began.
Chairman Powell used that word himself in Jackson Hole. He said you can expect pain, and jobless claims are at 186,000. Now, if you'd asked me back in August where claims would be as we kicked off February, Tom, I'm not sure I would have said in and around 200K.
You know, Tom, you are correct. There is a big distinction between a softening and pain. We are seeing the softening without the pain. What happens when we see the pain? And that's my point. Can we get away without seeing it?
Tom Constant was right, though. It's a process. I think we talk about this as if it's an event.
And that's
it's
been
a process. And to Tom's point, you can have what looks like a soft landing, and that could turn into a hard landing based on how far this Fed goes.
Which was the reason why I thought what Seth Carpenter yesterday of Morgan Stanley had to say was so interesting. They think the Fed's going to be cutting by the end of the year, the very end of the year, because the numbers are going to turn so quickly. It's slowly and then all at once with respect to jobless claims, with respect to job creation.
We use these fancy phrases. We'll use them again this afternoon. Cumulative tightening. No one has any idea what kind of lag there is between rate hikes and what kind of damage it will do down the road. No one has any idea.
Can I talk about something un-American?
Please do.
What kind of beer?
Budweiser is the official beer of the Premier League. Is that true?
Money talks, doesn't it?
It's actually incredibly American.
If you tell me that's true, Tom, I kind of believe you.
I'm sitting at Tots Stadium. I'm with the Tots.
It was a huge controversy.
Beavertown. I mean, Beavertown has a soul. It's Robert Plant's son. It's got character.
Wait, are you just sitting over there doing research on beer?
Why do you think he knew nothing about the ECB tomorrow?
You walk into the Tots Stadium, they're playing Adele. And
you love that, don't you?
Yeah.
You love that.
You know, that's what they do.
I think it's something very special.
Man City,
There's something very special about the start of a Premier League football game just before the music's playing.
It is. It was very.
The atmosphere,
I observed that. Yeah,
the fans singing. Cool. It's very special. It's not like basketball when they have to pretend there's an atmosphere, so they play music really loudly and hire a DJ.
Hey, watch it.
You know when they, what I mean? They hire a DJ and it's like great atmosphere. Everybody's like they're instructing the audience what to do.
It's like a bar mitzvah.
Like, through the whole thing. Like there's music in the game.
I'm sitting there with a suit and bow tie, and I got 10,000 people looking at me like, who the hell is this?
I'm told we got to go. It's a smart decision.
Yeah.
Futures are down. This is Bloomberg.
Lisa's right. It is like a bar mitzvah. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, Federal Reserve policymakers plan to hammer home the message that their work in fighting inflation isn't done. They're expected to raise interest rates by 25 basis points at the end of their two-day meeting today. Chair Jerome Powell is likely to keep further rate hikes on the table while leaning against bets the Fed will cut later this year. Former South Carolina Governor Nikki Haley plans to announce she's running for president. She would become the first Republican to officially challenge her boss for the nomination. Haley was ambassador to the United Nations under Donald Trump. Meanwhile, the former president raised less than $10 million after he announced that he's running, and that's seen as a disappointing haul. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
The biggest risk to markets is that we don't get a recession in 2023. The wage growth stays high, and the Fed, having maybe paused for a bit in March, then in the second half of the year, they actually end up putting rates up by more than is forecast and aren't able to deliver the rate cuts that the market's expecting for 2024.
That's the risk for a lot of people. So that's Mike Ballard, JP Morgan Asset Management. I'll catch up with Bob Michael of JP Morgan a little bit later, and he's going to talk about the same thing, that maybe this might be the penultimate hike of this quarter, but not of this year, because, Lisa, he thinks there's a real risk that they could end prematurely and start to hike again near year end.
Which is actually, on the margins, becoming a groundswell of an idea that perhaps we're getting some sort of situation, just like you said. They get inflation down to 4%, then it's sticky, and then there are signs that it starts coming back and it gets the Fed concerned.
I've got no idea. I'd just love to play these conversations at year end and see what they sound like relative to what the data looks like. I go back to what I said earlier. We're going to be talking about that phrase, cumulative tightening, and it makes people sound smart, but ultimately, what does it mean? We've just got no idea what the actions of last year will do to the economic data in our future. Zero. Look at what it's done so far. If you'd asked someone back in the summer what the data would look like in the first quarter of 23, would they have described the labour market as things stand with unemployment at 3.5% and claims where they are?
Would you describe this market as being tight? Would you describe this market as having real fear in it? And that's another question, right? Has the tightening been transacted through the market?
Sure.
Through what's going on with price action?
Well, certainly, Tom, we've got an easing of financial conditions over the last month that has undone some of that tightening.
There's no question. To me, that is the metric, and I'm really thrilled in the financial media, John. It's not they're picking it up from us, but everybody's picking up this idea of some financial conditions, and the fact is they've gone the wrong direction for a Powell trying to be restrictive. Constant says inflation is dropping so fast. He uses his phrase super restrictive, which is interesting to say at least. Okay, we got to do a surveillance correction here, and I was confused. Snap is a tech company? Like
you knew this. Yeah, you knew this.
Snap-on Tools, Kenosha, Wisconsin. And I mean, I'm sorry, there's a difference here. Snap-on Tools, Kenosha, Wisconsin, 12,000 bodies, 16% per year for the last 10 years. 16% for the last 10 years, per year. Snap, which is the world of Mandeep Singh, over the last, 5-6 years or whatever, -6%. I don't get it. Mandeep Singh, is Snap a tech stock? I mean, I just don't get this underperformance in this worship of these companies. Do they have any chance at Snap of being a profitable company someday like Snap-on?
Well, so I think two things here. One is the environment we are in right now. Inflation, we were talking about it before, is having an impact on digital ad spending for sure. Every company out there is pulling back on their sales and marketing spend, and that is trickling down to pretty much every vendor out there. It may not impact Alphabet, Google Search as much as it did Snapchat or Pinterest or the smaller guys, but you can see that every company feels advertising is discretionary, and that's what they're pulling back on. And look, Snap is a single product company. It's a one app company. I do think they can be profitable because they have 370 million daily active users. Tell me how many apps out there have that kind of scale in terms of daily active users? Probably 5 or 6. And so because they have the engagement, I do think it's a monetization problem, as is the case with some other apps. And over time, they did very well for 2 years during the pandemic. 2020 and 2021, they grew over 50%. So they have a growth problem right now, but I think they can be profitable if they keep their user engagement at this level.
Mandeep, because of time, I'm going to go to Facebook. Pre-pandemic, they did $21 billion in free cash flow. They've basically have that. Has Facebook seen their best days?
I think in their case, yes, because they are losing engagement. And I go back to engagement because ultimately in the internet world, you don't have a very long life if you can't keep user engagement. And there will be something new, generative AI or something else that will be better. And Facebook can make any acquisitions right now. I mean, they bought WhatsApp and Instagram at just about the perfect time to add to their business. Well, guess what? Right now, the regulatory environment is against them. So I do think their best days are behind, but at the same time, they can improve their free cash flow once the cyclical downturn in ads kind of improves.
Mandeep, there was a huge question emerging from Snap's earnings yesterday about whether Apple's security policies that went into effect a little bit ago have, in effect, killed some of the advertising model of Snap and Meta.
Absolutely, and I think all these companies are redesigning their ad stack. So the good thing for Snap, and I think we're going to hear from Meta as well, is they are able to leverage their first-party data. I mean, previously they were tracking all kinds of activities outside their apps for ad targeting. but now they are able to improve their ad targeting based on just the data within their app. And it's still better than, what you see on linear TV. So digital ads will always have that advantage in terms of ad targeting that linear TV doesn't have. And I do think it's a work in progress. It's not going to take a couple of quarters. It will probably take longer. But these companies are redesigning their ad stacks as a result of Apple's privacy changes.
Mandeep, Tom asked a really good question about whether this is a tech company, and you started talking about some of the potential software and different programs that they could potentially come up with. But are we seeing a bifurcation into companies that perhaps use tech, which is most of corporate America by the end of 2025, versus the true technology companies where their core is some of the new and more advanced technologies?
Well, so look at the amount of data that these companies are generating in terms of the app usage and everything that they're collecting, and then they're leveraging AI and machine learning for ad targeting. So these are all the cutting-edge technologies that are currently around us. They're using a lot of computing capacity, and I do think I will put them in the tech bucket. They have a monetization problem, unlike the software companies, which have a recurring subscription model, and that's why, you see the volatility in their stocks and their growth rates.
Tremendous volatility in Snap, at least. Anyway, Mandeep, thank you, sir. Mandeep Singh there of Bloomberg. Snap is down more than 15% in the pre-market. Meta, Facebook, a little softer in sympathy here, going into earnings after the close. Facebook down by about 1.26%, Tom.
I mean, Mandeep has prodigious skills within the industry. He brings real industry cred. But all of the Mandeeps out there, they've really never enjoyed where money costs something. It's incorrect. It's not. It's always been free. It's always felt like it's been free. And that's changing.
But it's not just that, Tom. It's not just that. We had this massive pull forward, huge pull forward in demand. And we talked a long time, Lisa, about these companies being immune to the cycle, having these really strong secular growth stories, which will continue forever. Now I think there's a challenge to the latter. A real challenge to the latter. And on the former, on the cyclical immunity, I'll say this about some of these names, and I've said this before. I think a lot of people agree with this. Some of these names in their current form have never had a cyclical challenge. They've never had that before because the pandemic did not equal that at all for these names.
And Snap is the perfect example for that, with the first ever expected quarterly decline in revenue. That gives you a sense, at least reported, because they did go public in 2017, but this points to exactly what you're saying. They haven't encountered anything other than growth. What happens now? How do they adapt and adjust at a time,
part of the great zombie roll-up?
Well, especially at a time when social media is moving so quickly. Can they move towards some kind of metaverse that isn't necessarily taking off for Facebook in the way that they hope?
What's the debate in the Abramo household? What's it sound like?
Okay, well, we were discussing whether Snap had any lasting power, and it really is the critical mass of the social use that ultimately determines its efficacy, because if people are using it for a tool to find each other and to, track each other and then have Snap, I don't really get why people do this.
They track each other.
Well, yeah, then they say, oh, he's there. Oh, my gosh, all my friends are there. Why are they all together and not with me? And then they start
that sounds dreadful.
And, that's welcome to high school.
What's the difference between TikTok and Snap, seriously?
Oh, it's totally different. I mean, I don't know. TikTok.
I love this. This is great.
Do you actually like this?
This is great.
TikTok is more videos. Snap is actually like snaps. And I think they disappear. I'm not an expert,
but right?
I think that's the key.
Do you remember when you'd go to meet up with your friends and if they didn't show up, you'd have to find a payphone and call their house?
Oh, I'd go to their houses.
Yeah, or you'd just show up.
I would show up.
Right. You'd show up, you'd bang the door down. Where is everyone?
You?
Yeah.
Well, I was the person.
First girlfriend John had, everybody else was throwing little pebbles against the windows. He threw a brick through the window.
I'm not going there. That never happened. Christian Muller-Glissman's coming up from Goldman Sachs. Looking forward to that conversation. That never happened. People believe some of TK's stories sometimes. Snapchat's down about 15 or 16%. Meta coming up after the close. Look out for that. And then over the next couple of days, just a phenomenal amount of earnings. What have we got? Apple, Amazon,
Alphabet.
To round out big tech. Looking forward to it. Futures down a third on the S&P. Live from New York on Fed Decision Day. Ton of economic data as well coming up this morning. Stay tuned for that. This is Bloomberg.
The Fed wants to see real yields higher, really to make sure inflation is down and stays down for a while.
The Fed is hawkish, but they're sort of reiterating a message that the market's already kind of gotten comfortable with.
There are a lot of structural forces at play that are not going to bring us back to 0% or almost no inflation.
They're going to be very careful about signaling that they're ready to pause and cut before they know it's the right time.
What the Fed does matters, and it matters a lot for the global economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The Federal Reserve decision coming up this afternoon. Live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures are negative about 1/3% on the S&P TK. As we kick off the month of February, are we looking for 25 from this Federal Reserve?
Well, it's a big mystery this afternoon. We'll kick it off with Richard Clarida, some other great guests. I'm really looking forward to talking to Priya Misra with that great inversion call, the re-inversion we saw yesterday under 70 beeps. Right now, negative 71 beeps. And, you know, I think it's a great set of guests to set up the optionality now, but what will Chairman Powell say about his choices, his degrees of freedom out 2 and 3 meetings out? That's a mystery.
And Lisa, will he push back against the easing of financial conditions we've seen over the last month?
And perhaps the way he could do that is to talk about indicators that he's watching that show greater inflation than others. There was a story about supercore inflation, and this is the new hot metric that the Fed is looking at that strips out a couple of things that are actually going down and looks a little bit hotter than others. So, you know, there are ways that they could try to tweak it, but will the markets actually listen?
Apollo's Torsten Slok, he writes the following this morning. He's just published. He says, Tom, it is continuing to look like a soft landing. He said that ECI wage inflation is coming down. The consensus is expecting non-farm payrolls on Friday to come in at 190,000. And he said none of the indicators the MBER recession committee normally looks at suggest that we are in a recession at the moment.
Yeah, and what's so important here, John, is the basic idea of what is the history of disinflation. And as a generalization, it's largely what's called stochastic, which is when it moves, it keeps moving lower. And that's how you get to the repeated 3% inflation calls by some respected houses.
The problem you've got is that the MBER might look at one thing after the fact to look back and say, yes, that's what it was. The market's looking at another. Yield curve inversion, PMI sub 50. That's the tug of war right now.
So what are the specific indicators that people are going to get a sense of to know that they're right or wrong? Because right now people have a lot of conviction in their bet against the Fed. And to me, the employment cost index yesterday was telling. The fact that markets moved so much to this idea that the employment costs weren't going up as quickly as they previously thought perhaps points to the power of jobs.
That powered the S&P yesterday, that's for sure. The S&P 500 closing higher by almost 1.5% this morning. Good morning to you. Equity futures look a little something like this. We're down 1/3% on the S&P. Yields are coming in a couple of basis points on a 10-year, 348.64. And euro dollar firmer by 1/4% at 108.91. Looking for the Fed to go 25 potentially today. Tom, maybe they surprise and go 50, but we're looking for the ECB to go 50 tomorrow.
And the combination, I think, is important, John. It's a statement by central bankers of what we're going to hear. The one common feature here is, let's go Latin, ex ante, ex post. By definition, they're after the fact. And I think Chairman Powell, going back to Jackson Hole in an 8-minute speech, I think they were switching your blanket. I don't know if you got the whole speech at that time, John, but the basic...
That was cold that morning, don't you?
The basic, he's back? What do you mean he's back? We're not ready. But the answer is, if it's an 8-minute press conference, it's all going to be the same, which he's going to say, we have to wait for the data, including Jobs Day on Friday. Can you imagine if Jobs Day shows disinflation?
True. You do what you always do when we're outside in the cold. You steal the heater. Lisa can confirm that. Bramo, TK always steals the heater. Never mind the blanket.
You mean like the 2 heaters, just sort of facing
Stanley Fisher
you and I were just kind of struggling.
Moves it towards him.
Stanley Fisher, IMF giant, I believe still now at BlackRock. Professor Fisher taught me that trick.
Just kick it to
Stanley
your
Fisher
side.
at Davos. Get the foot out. Stanley Fisher needs the heat.
Adam Posen had a unique view on it by just wearing a short sleeve shirt.
There's photos to prove it.
38-degree weather. Today, here's what we're looking at. ISM manufacturing data comes out for the month of January, and then JOLTS job openings for December. Manufacturing has been bleeding softer for potentially the 5th consecutive read. Do we start to see an ongoing weakening, an ongoing deepening in the contraction there? But the job openings is what I'm watching. Do you see a softening in the labor market that starts to come through in a leading indicator, not a lagging one. At 2 p.m., we get the FOMC rate decision, followed by a 2:30 p.m. press conference by Fed Chair Jay Powell. We will be speaking with some incredible guests, including Fed Vice Chair Richard Clarida, Priya Misra, we've been talking about with the yield curve inversion discussion, Diane Swank of KPMG, and Greg Davis of the Vanguard Group. And then aftermarket, Meta reports earnings. To me, this is going to take on a new importance, particularly because it builds on what we saw from Snap. This concern about the first negative revenue growth that we've seen in Snap's history. Do we see Meta struggle with some of the same issues, John? And how much is this a read on the broader economy with respect to ad spending versus an idiosyncratic model that, as you've said, hasn't really faced this kind of cyclical downturn for its industry?
Is it a company problem, an industry problem, or an economy problem? And I think a lot of people think it's definitely one, it's definitely two, and it's probably three as well, Tom, as we look for economic growth to soften through the rest of this year.
Well, the real growth is going to be something that's going to soften through the year. I think everyone agrees on that. That's where we talk, John, about this domestic final sales, which takes a lot of the trade noise out and the inventory dynamics out. But even if inflation comes down, that gives you a nominal GDP to keep it going. Does Europe have that same animal spirit, that same nominal GDP?
Let's keep this conversation going. Joining us now, Christian Muller-Glissman, the Managing Director for Portfolio Strategy over at Goldman Sachs. Christian, a simple one for you. Are you expecting Chairman Powell to deliver a little bit of pushback later on this afternoon?
Yeah, I mean, it's a good question. I think you mentioned it earlier already. It feels like the data has been quite supportive and you're making progress. I think the wage inflation is coming in, the services inflation is coming in. I think you are on track for a soft landing. Certainly markets are shifting in this direction. So it seems to be like everything is on track. So we expect him to reiterate the message he has given before. We expect 3 more 25 basis point hikes and probably a relatively balanced meeting. You mentioned it earlier. To me, the macro data will be much more important. I think the central banks are probably a bit in stay the course mode.
Christian, we talked to the head of the Norwegian Sovereign Wealth Fund yesterday, who's got an immense challenge moving the needle because of his mass, his size. Many of us don't have that problem. Do we want to be index-based or more choosy, skew to a lower R-squared, more actively managed?
Listen, I think, as you know, in the last cycle, it was fine to be in indices. I think the market cap weights were in your favor, both in global indices, with the US being the largest market, and within the US, with tech being the largest weight. And what we've been saying for some time is that in the next few years, stock picking will get more important, not the same sector leadership, not the same style leadership, and not the same regional leadership. So it means you have to be a bit more active.
Christian, looking forward, I know Goldman Sachs has the view that oil prices are going to go up. What trade does that challenge that we saw really in vogue during the month of January?
Yeah, I mean, like, it's the big conundrum. Everybody's starting to believe the soft landing is happening and China is reopening and Europe is avoiding the energy crisis and the recession as a result. But the oil price hasn't moved. And I think it's in my kind of category of good news becomes bad news risks, because both rates haven't really followed in the optimism and the commodity prices, in particular oil. So if they start following, it further cements that kind of growth is fine narrative. And that eventually means that good news might become bad news because central banks have to react. So I think the reason why oil hasn't reacted as much might be related again to the winter because of less gas to oil substitution and because there's probably still a lot of kind of oil floating around with regards to Russian oil, which is being discounted. But I think net, it's been a big lag.
Christian, would you then lean against this long euro trade that we've seen, long European equities trade that has really dominated all of January?
I think generally we prefer non-US versus US markets for all kinds of reasons. I mean, non-US equities are cheaper. There's more runway economically. There's more slack. So you have like a European manufacturing slowdown. You have exposure to China. So I think generally it feels like Europe had a bit of a better asymmetry, both from a valuation point of view and where you are in terms of growth, there's more room to improve. The challenge you have now is the repricing has been incredibly fast. So if you look at risk premium credit, like European credit versus US credit, cyclicals versus defensives in Europe compared to the rest of the world, and also the equity risk premium, you've taken out a lot of that discount in a short period of time. I think momentum can continue to be positive, and risk premia are seldom a good market timing tool. Like short term, you always want to follow momentum, and in the more medium term, valuations and asymmetry matter more. So in the near term, we're reasonably constructive on Europe.
Just quickly, Christian, how far do you think this ECB takes interest rates?
So we have determined a rate at 3.25, and that's 2 more 50 bips and then another 25 bips hike. And I mean, it's already quite amazing where we have gotten to, considering from negative rates. But I think the fact, what we're learning here everywhere in the world, is that we're not as addicted to low rates as we thought. There is a certain ability to deal with higher rates. And we know that in Europe, that historically has always been a bigger question mark because of sovereign debt concerns. And we'll have to see how that kind of comes back. But as of now, Italian BTP spreads have come in, and you are in this positive growth momentum phase. So I think 3.25 is the base case. And depending on inflation normalization, of course, there's kind of risks to both sides.
The deposit rate right now, 2%, maybe 125 basis points still to go.
Wow.
Christian, thank you. Christian Muller-Glissman there of Goldman Sachs. To Christian's point, and I think we're all in agreement around the table on this, surprised by how well the Eurozone and European markets specifically have dealt with this.
Brief us on the Italian spread, AC Milan to Juventus. I mean, how's it going?
Yeah, I can't give you that spread
okay,
right now.
But give us
Juve's got its own problems. That's a relative story. Milan better than Juve in absolute terms, both dreadful, okay?
Thank you. Give us the Italian spread story. Oh, I love pushing the buttons.
You want me to talk about Italy?
It's Italy spreads.
I'll bring up the Italian spread
Christian
right now.
said it's a good story, right?
The fact that 10 years at about 4.24, and we're not talking about 6% and a repeat of the Eurozone debt crisis, is good news.
Yes.
It's good news, because if you'd asked me again a year or so ago, they're going to do what they're going to do, QT on top of that, I wouldn't have been talking about 4%. I'd be talking about a whole lot more.
Can we come back and talk about the Apple performing stock nobody talks about?
What's
it's
that?
a mystery. I'm not going to, it's a secret. You have to come
You've
back
got a secret stock.
It's a secret.
Stay tuned.
It sounds like financial news from the 90s.
These people get no love, and they've done better than Apple.
Up next, the secret stock.
Secret stock.
I can't wait. Wrong network, Tom. Futures down 0.25% on the S&P. This is Bloomberg.
That's a tease for you. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Policymakers at the Federal Reserve are expected to moderate interest rate increases again. The Fed is wrapping up its two-day meeting today. Chair Jerome Powell is likely to keep further rate hikes on the table while leaning against bets the central bank will cut later this year. Inflation in the Eurozone slowed down more than expected in January. Last month's reading came in at 8.5%. Now that suggests there will be a more heated debate to come at the European Central Bank over how much more interest rates should rise. The UK has been hit by its most severe day of strikes in more than a decade. As many as 475,000 union members are on strike today, closing schools and crippling the nation's rail network. They're demanding pay hikes to offset the cost of living crisis. Investors hurt last week by the malfunction at the New York Stock Exchange are trying to get their money back. But Bloomberg has learned that claims are likely to exceed the liability pool that covers losses, and those losses could total in the millions of dollars. And the crisis of confidence plaguing Madani is getting worse. The stock sell-off triggered by Hindenburg Research's fraud allegations has erased more than $93 billion in his value from his companies. Now, the rout has cost Adani his position as Asia's richest person. He's been replaced by Reliance Industries chairman Mukesh Ambani. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
In order to avoid the hard landing, you need to scurry very fast to get back to neutral, which we think, and the Fed certainly still thinks, is around 2.5%. And that's the story for 2024. This isn't a choice of soft versus hard landing. It's a soft landing until it becomes a hard landing. And that's why the Fed needs to be very alert to that reversal in policy.
And that's why the Fed is in such a tricky position. That was Dominic Constant, the head of macro strategy at Mizuho Americas in the last hour or so. Just a fantastic conversation there. It's a soft landing until it it's a hard landing. And they've got to balance two risks, the risk of doing too little versus the risk of doing too much. And you have to imagine, Tom, those two risks have come into balance a little bit more over the last couple of months.
I think they have since the last meeting. Absolutely. And just the news of the last day, the separation of, John, you follow this more than I do, is a generalization, hard data versus soft data. There's a pretty wide gap right now in the information we're getting from those two groups.
But I think the market is responding to the incoming information.
Yes.
ECI softer, inflation's coming in a little bit. We've got a sub 50 PMI. That's what the market is adjusting to. What it doubts, and I think this is the difference between the Federal Reserve and markets right now. If I go back to that Kashkari blog from early January, Neil Kashkari believes there are 3 steps to all of this. In fact, we're going into the second step. The second phase of all of this is to pause against a backdrop of inflation disinflating. They just want to stay there. They want to stay there and make sure this is gone and gone for good. And that's where the doubt is. People just don't believe they're going to get there and stay there.
My problem is people are looking at the data, and the data is coming in the soft, as you were saying, Tom. The soft data is sort of showing a very different picture than the hard data. You can pick whatever data point you want and make your own narrative, and that is the problem. So where data does the Fed focus in on to understand what backdrop they really have?
We get a lot of data today. Is JOLTS more important than ISM? John, I'm sort of with you in that ISM sort of gets out front of where we are. It's sub 50, prices paid. I mean, manufacturing.
Let's make it simple if we can. Do you believe the inflation problems of the last few years were mainly supply side or demand side? And if you believe they are demand side driven, then that labour market should make you nervous. And if they believe it is, and I think they do believe that it is demand side driven, there is an element of that at least, it's not all supply side, then that labour market will make them nervous. Claims at 186,000, unemployment at 3.5%, will tell them that this job is not done, which is why we keep hearing that phrase, the job is not done. And I imagine that's what we're going to hear a little bit later.
And I'm guessing that JOLTS won't sway them in any way because we're still seeing more than one job, more than almost 2 jobs, open jobs for every unemployed American.
That's the dream. You get JOLTS down, job openings down, and unemployment doesn't have to come up too much, and it's all perfect. Yeah. Wages soften.
That's what I'm worried about.
You're worried about what?
Just
Wages
kidding.
softening?
Yeah, everything perfect.
Is it that time of year?
I'm worried about Anne Marie standing up and leaving the set. Joining us now in Washington, listening to this, Anne Marie Horton, our Bloomberg Washington correspondent. Anne Marie, we talked in the previous hour about this really important meeting of the Speaker of the House and of Mr. Biden as well. I want to digress here because we're going to talk about T-Mobile here in a minute on the regulatory tone in Washington. The miracle of T-Mobile, which we'll get to, is that they really just ignored all the regulation garbage in Washington and delivered a superior product. Do you get the tone forward this year that the Biden administration is racing towards more regulation, more of a blanketing of what industry can do?
Well, today he'll be meeting with his competition counsel, Biden, a number of aides, as well as cabinet members. And one part of that, besides this credit card fee issue that they plan to announce, they want to decrease that fee from $30 to $8, and they think this is going to save consumers billions of dollars, is they're also looking at the application market. So when you go into the Android app, I think it's called Google something. I have an iPhone, so that one is just your app store. They think that there's not enough competition there. But this is not new. The previous Congress, there was a bill that was advanced about more competition in this marketplace on a Senate panel. It just didn't get to the Senate floor for a vote. So this today is really about shedding light on that and asking Congress to act on.
But for those of us that are fossils that remember the day the government walked away from suing Microsoft, it's political. Do the Republicans have a stark difference from the Democrats, or are they all on the same page of going after big tech?
I think there's nuances in it, but it is fair to say that there is moments and levels of bipartisanship when it comes to concerns each party has when it comes to big tech. But sometimes those concerns always don't match up and they don't line up, especially when you look at the likes of the social media companies when it comes to Meta or when it comes to Twitter. There's big concerns, but they differ on each side.
Meanwhile, we see the Biden administration kind of towing both lines. On one hand, trying to cater to some of the further left side of the party with certain consumer demands. But on the other hand, there was a story about the Biden administration actually providing support for the drilling project of ConocoPhillips in Alaska, which goes against also some of the left side of the party, particularly the Green side. How much pushback is he getting inside the Democratic Party?
Well, the progressives and the environmentalists are certainly not happy about this announcement. But what we have seen over the course of the past 2 years from this administration is they've had to really pivot when it comes to energy policy. This was a president who, remember, called Saudi Arabia pariah and then had to make a trip there when gasoline prices were flirting with $5 a gallon and then head north of that. So this is, I think, a recognition of the administration that while they have an aim to want to electrify the grid and change the energy landscape, that it is in a transition. And maybe it's not as far ahead of a transition as many on the left wing of the party had hoped it to be. So they really have no choice, though, right? Because there's sanctions against Russia. There's a number of issues at play in terms of the energy landscape. So when deals come ahead, they're going to have to, with some of them, give their okay, even if it means upsetting the progressive wing of the party. But remember, also, midterm elections are over. He's done a lot the last 2 years for the progressive wing. So this is just really a reality check.
AMH, down in D.C., great to catch up.
Regulation.
We're taking the show down to Miami with everyone else. So I promised you this data about an hour ago. I can bring it to you now. Net migration, net domestic migration, California.
Yeah.
Year-over-year change, California, negative 0.3%. New York, negative 0.9%. Illinois, negative 0.8%. Where they're going, we know, Florida, plus 1.9%. Texas, plus 1.6% year-over-year change, Tom. Real numbers they are.
These are real numbers, and why do we think it's a one-off? I'm hearing conversation to conversation, anecdote to anecdote. Wow.
I always thought it was the weather. The naive foreigner in me would come over here and always thought it was the weather. And then I realised, Tom, it was more than just the weather. It's taxes too.
It has a little bit more to do
and a whole lot more than that.
Humility's in order here, folks. I can line up the times I've been wrong. I tell you, John, this is a really important thing. Study, study, study when you fail. It's not my biggest failure. My biggest failure was thinking Lula would blow up Brazil. I was wrong. The bottom line is my second biggest failure was the guy with a pink T-shirt. T-Mobile, in the last 10 years, out with earnings today, has outperformed Apple Computer. Fractionally. But they're up 24.3% per year. Their free cash flow build, John, from pre-pandemic is an act of God, and they have flattened the competition, including Verizon, which is flat free cash flow from 2019.
Did you judge him because he wore a magenta T-shirt?
Yes, and I told him that. I told him. I met with Legier, and I said, I just want you to know, other than Lula, you're the single guy I've most been wrong on in my career. This is an undertold story. Full disclosure, I have 7 phone lines with T-Mobile, including vet bill and kennel fee. But the bottom line, John, is you study your mistakes. And this is my biggest market mistake in 10 years, was not climbing on T-Mobile.
You know, there's some talk about him maybe being the one that should run Twitter.
Oh, I didn't know that. Really?
Oh, wow. I've heard his name thrown around.
Well,
yeah.
can you
not
imagine?
Heard that?
You know,
this is not exclusive reporting. Just for that.
But to me, I just wonder.
It's not break exclusive.
The egos. Do you
we
think
need more
Elon
breaking
Musk
news here. Come on,
and that
John.
man, those egos together would actually do okay?
I saw it out there on Twitter, people talking about it. You know, people say this is who should run it and blah, blah, blah.
Should and will.
Yeah, very different things, as we know. Live from a snowy New York City this morning. Good morning to you. Mike McKee informs me the Central Park has recorded the first measurable snowfall of the season, Tom. This morning, half an inch. There you go.
So late. Not very much. I mean, the fact
So
that we've been
late. How
talking
dare
about
it?
that.
How
I
dare
know,
it
it
come
should have
so
come
late?
earlier. It should have.
You've seen the temperature for this weekend?
It's going to get very cold for like a day.
Like legit cold.
Yeah, legit
I would agree.
cold. Like American.
Like 5 degrees.
Jackson Hole was
like
0
we're not going to argue
yesterday.
about whether it's cold or not. It's
no,
like freezing.
it's 0, and it was going to be 3, and then it was going to be 8, it was going to be 12, but this is back to 1869. You know, I'm not smart enough to know if it's global warming or whatever, but I can certainly say, Lisa, you mentioned
clearly
this.
not warm.
There's changed behavior winter in New York without the slush, without the snow. You know, it's a different winter.
It's less difficult to get up in the morning when it's not freezing, to get out from under your blankets. And so I think it makes January go faster. That's my theory.
That's your theory on why January went so quick?
That's correct.
Okay, wonderful. Here's the price action for you.
Please.
On the S&P. We'll leave that there. On the S&P right now, we are negative 0.2%. Things went fast for the bulls because they were so good in the month of January. The Nasdaq 100 last month up by 10.6%, best month since July 22. The S&P was up 6% last month. The Euro Stoxx 50 in Europe up almost 10%, best month again since November 2020. That was vaccine time back in November 2020. What a run we saw last month, Tom.
To me, what's important here, and this is off Ralph Ankampora's statement that October was the low, the Bloomberg Total Return Bond Index is up 7.8%, 32% annualized, which defeats the idea you can't make money in bonds, granted off a horrific 2022.
Let's talk about the bond market. 2s, 10s and 30s look a little something like this going into the Federal Reserve decision this afternoon. Your 2 years close to 420. It's been hanging out at this level for the last couple of weeks, but I think the interesting point here is the Fed is pushing towards 5%. Not there yet, maybe in the meeting after this one, but the 2 year is still at 420. The 10 year is at 350, and that is the yield curve inversion we face. Fed funds out to 2s, Lisa, Fed funds out to 10s and beyond.
Yeah, when will the market either reckon to what the Fed is saying or the other way around? I want to just give you a couple of names because this is earnings season and the moves are telling of the divergent fates of different corporate scenarios. AMD, when we talk about the chip makers, AMD actually came out with better than feared results and their shares are being rewarded in pre-market trading up 3.5%. Western Digital, the exact opposite story and down 4%. So just to give you a sense how even in the same industry, you can really get the winners and the losers. A very difficult time to come up with some sort of generality for all of the market action that we're seeing. When you take a look at some of the tech names, Snap, we've been talking a lot about, those shares lower by about 15% after they forecast the first drop in revenue in their public existence. What this means for Meta, a big question, although people are not wasting time. They are selling, and those shares did lower by nearly 1%. But all of the tech shares have gained so much this year. How much is this just basically taking some chips off the table just in case, rather than some sort of wholesale repudiation? Match, though, just to give you a sense of some of the companies that have grown up over the past 5-10 years. This is the dating app that doesn't see any material improvement in its business model going forward. Those shares down more than 8%. How many other companies are there like that have existed because of a very benign environment and monetary situation that are now going to have to reckon with perhaps a very different reality?
And Meta as well. Two names which have commoditized people.
I'd say a lot more as commoditized people, but let's move on.
Just going to throw that out there. Are we done?
Are you done, Lisa?
We're so done, TK.
She didn't mention Peloton. I mean, she wrote the headline for the Peloton people. Peloton, thanks Mark Gurman for this, our ace on Apple. Look for Mark Gurman tomorrow. Peloton no longer at, quote, brink of extinction. His loss is narrow. Now, that's a Bramo headline. That's a Bramo headline.
They're still in a spiral of doom.
Brink of extinction.
That's fantastic.
It's a relative game in marks, isn't it?
Yes, exactly. So
Is that better than expected?
I have no clue. Ask Mark Gurman. Mark Gurman tomorrow on Apple, Bloomberg with our world-class coverage there that we'll see. Right now, and this is important, a bond update to get to the Fed meeting today. Robert Tipp joins us, Chief Investment Strategist at PGIM. Robert, I was going to do a real yield analysis, but John Farrow on the Data Check nails it with a 2-year yield. Where should the 2-year yield be now, or where is it heading to off of Fed action, 4.19%?
Yeah, I think there's a message in that inversion out to the 2-year note. I think that 2-year yield could be headed a little bit higher. You know, I think the Fed has been very steady on their anti-inflation message. Could get a little bit of upward pressure here on yields in the near term. The markets are screaming, though, and even the Fed's indicators for recession, which would be that first 18 months of the yield curve, are inverted, are screaming for them to stop. And in 2018, you know, they did one more hike than they kind of needed to. They're probably going to do 1 or 2 more hikes than they need to this time. But everything is coming together for what's a really kind of a weird bull market compared to what we're used to seeing. But as you highlighted, Tom, the returns are starting to come in and they have a long way to go.
Robert, why is the bond market right and the Fed wrong?
The bond market has, fear and greed operating. And what we saw in 2022 and off the yield lows in 2020 was the fear side of it. The market saw the inflation like they'd never seen it before, and then they saw growth come screaming back. And the markets, went to an extreme all around the world, not just in the U.S., in Europe, Australia, every place, even Japan, to get ahead of those central bank rate hikes and this aggressive fight on inflation. Now, frankly, they're ahead of the curve. Everything that was supposed to happen is happening in spades. The growth is moderating really around the world, but in the U.S. as well. It's still a very solid backdrop, I would argue. We're going to have rolling unrecessions where people are surprised that you don't have serious downside problems, but it's moderating. And the inflation numbers are coming down in spades. They had another negative print in Europe. Your core ex-shelter in the U.S., kind of a, real center of that inflation, the sticky part you would be worried about, has been negative for 3 months. Commodity prices are down. Everything is coming together. So I think the market, short term could be a little bit jarred by the fact that the Fed is still on the roll here. But everything's coming together for them to hike 1 or 2 more times and to be done.
Robert, let's talk about what John was bringing up, the concern that let's say they do pause. Let's say the Fed gets what they want and they stop in March. And then inflation doesn't go down much further. It stops at 4%, even 3.5%, but does not continue to disinflate. What then does the Fed do?
Right. They're going to hold. Right. And I think that is going to be what's going to happen. I think headline inflation is going to come down more rapidly because commodity prices have come down rapidly. A lot of goods prices got really elevated. It's easy for them to drop off a bit. But I think your below target inflation that we've had around the world, I think that was kind of a one-time fluke, a lot of competition coming on the heels of the financial crisis. We may stay a bit above target. I think the markets may be wrong about that. And so this bull market is not going to be big profits coming from yields having a huge tumble. This is going to be a bull market that stems mostly from yields getting high, and they have gotten high across the curve and staying high.
Is there follow through here? It's been a lovely January, a nice fixed income bounce. Do we break out to a new regime or do we churn?
Yeah, I mean, when you look across fixed income sectors, your yields, on your general market, whether it's investment grade or below investment grade, they're back up to 2002 levels. So the clock has been turned back, to the beginning of the last phase of the prior bull market. And so you're going to have solid returns from fixed income over the next 10 years. Now, what profile that's going to take over time? Do yields go up a little bit right now as the Fed finishes their rate hike cycle? I think there could be a little bit of give back in the short term. But big picture, it is going to be a slow and steady. So a little bit slower rate of return than what we saw in the first month.
But Robert, what's important here is if I have a success and I finally got the bounce after a horrific 2022, do I adjust to a shorter duration? Do I adjust to a different credit type? Or do I adjust to cash?
I think the danger for a lot of investors in the inverted yield curve environment is going to be that they do choke up. They come in on the yield curve. They do not maintain their duration. And 5 or 10 years from now, growth in aggregate is probably going to be slower than it is now. You won't have the post-COVID stimulus and enthusiasm. Inflation will be lower. Rates will be lower. And the people that are in cash or they're in bills, they will not have locked in those long-term returns. And on the off chance that inflation very quickly drops down below target and central banks actually do end up cutting along the lines of or more rapidly than what's priced into this curve, investors that have stayed short, that have not been in long-term fixed income, are going to miss out. They will have had a year or two of high yields, 5%, 4%, depending upon where they are, or 9% if they're in high yield and they don't have defaults. But it's going to be, if they're in the front end, they're going to get that 4%, and then it's going to be gone when short rates come down. If they're locking in at the back end, in high yield, in hard currency emerging markets, or long-term general fixed income, or even 1 to 10-year fixed income, that yield is going to be with them for the duration.
Robert, just quickly, how would you respond if the Fed went 50 today?
Yeah, I think economies have a lot more underlying oomph, are a lot more resilient to central bank mistakes. And 50 today would be a mistake. Honestly, personally, if I was in their shoes, I'd say, hey, we were going to hike 3 times this year, 25 basis points. Obviously, we're planning on skipping 5 out of 8 meetings. We're skipping today. We've seen ECAI, we've seen CPI, we've seen all these things. Doesn't mean that we're not going to hike more. We're just not hiking today. We told you we're going to skip meetings. We're skipping today. And then you'd end up skipping every meeting this year if things keep going the way they're going. They do 50 basis points. Given what they've seen on the inflation side, there've been head fakes. The data has been revised under their feet. It would be understandable in some sense, and it would be a recoverable error, in my opinion. But it would be, more than is needed at this point.
Robert Tiff, thank you. Diplomatic over at PGIM Fixed Income. If they skip today...
What is it about today?
If they skip today, I'd be pricing in cuts tomorrow.
A recoverable error sounds like the Red Sox strategy.
Well, him and Don
winter.
Constant are very, very diplomatic, Tom, aren't they?
Little barbs kind of put in there with the same tone as everything else. It was fantastic.
McKee, stand up. Excuse me, Mr. Chairman, is today's signal a recoverable error?
It's a fascinating time where people are talking about rate cuts, potentially on a year where Chinese GDP could be 5-6%.
To me, the takeaway from that conversation is the market's right, the Fed is wrong, period, full stop.
A lot of people share that view, don't they? Wouldn't be the first time the market's been wrong, though.
That's the concern.
Yields are down a couple of basis points, 348 on a 10-year. Equities are down 0.1%. The Fed decision coming up. ADP jobs in about 30 minutes' time. We'll break that down with Mike McKee.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers plan to hammer home the message that their work in fighting inflation isn't done. They're expected to raise interest rates by 25 basis points at the end of their 2-day meeting today. Chair Jerome Powell is likely to keep further rate hikes on the table, while leaning against bets that the Fed will cut later this year. Former South Carolina Governor Nikki Haley plans to announce she's running for president. She would become the first Republican to officially challenge her boss for the nomination. Haley was ambassador to the United Nations under Donald Trump. Meanwhile, the former president raised less than $10 million after he announced he's running, and that's seen as a disappointing haul. The CEO of Boeing says it's a matter of not when, but not if, but self-flying planes will come to commercial aviation. Dave Calhoun told Bloomberg TV the company's autonomous flight technology being developed for the military will eventually come to commercial jets.
As you may know, we have an application on an all-electric autonomous airplane. We refer to as WISC. And that airplane, that application is in, and the FAA will begin working with us today on building out a certification program for autonomy and for WISC.
Calhoun spoke at an event making the final delivery of Boeing's iconic 747 jumbo jet outside Seattle. The plane is a cargo version that will be flown by Atlas Air. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Our view coming into this quarter was not necessarily that the results were going to be all that great. It's just that expectations were so low that it just put risk reward to the upside. Expectations were low, positioning were low. So in that sort of combination, it doesn't take a whole lot to get the stocks moving higher.
That was Stuart Kaiser there of Citi, live from New York City. This is Bloomberg. Equity futures right now on the S&P down by about 0.1%. Coming up a little bit later on this afternoon, the Federal Reserve decision is this afternoon. And in about 20 minutes, in fact, about 30 minutes, you're going to get the ADP report. Then onto the ISM, job openings and all that good stuff, TK. It's a busy morning. And then after that, this afternoon, after the close, you get Meta earnings, Facebook. Then onto tomorrow, Amazon, Apple, and Alphabet over the next couple of days.
We've touched on it, but I think we really have to say this is a bit of an odd meeting and that there's a substantial amount of data coming out today. And I'm going to go to the Ferro indicators, which is ISM. John, tell people why ISM matters to you.
It's sub 50, and 50 is the dividing line between expansion and contraction, Tom. And contraction, sub 50 ISMs, usually you sit up and pay attention. You get another one, you pay more attention. You get a string of them, Lisa, and we've had a string of them. You should be paying a lot of attention. So it's weird. It is weird historically to have sub 50 ISMs in a Federal Reserve that's hiking. and it will be hiking today.
This is weird in a lot of ways, though, right? I mean, we've gotten this sort of rolling recession, a manufacturing recession, but a services expansion. So how do we describe weird in terms of economic policy when you have this sort of rolling economic cycle that's very hard to nail down?
Do you want something less surprising?
Yes, please.
Exxon. Okay, Exxon, no drama this morning at the pre-market. It's down about 0.25%. But the earnings beat expectations with a record $59 billion profit in the last 24 hours. So you can imagine what the feedback was like from the White House. Here's the quote. It's outrageous that Exxon has posted a new record for Western oil company profits after the American people were forced to pay such high prices at the pump amidst Putin's invasion. Tom, I think that response quite predictable after what we heard about Chevron.
It's predictable, but there's a different tone in Europe. I'm fascinated, John, by the distinction here of Europe where there are windfall profit issues and here where it's a huge debate.
Well, that's the makeup of government, right? They can execute. They can make the decision. They've done that. Tom, there are other industries that maybe we should be talking about windfall taxes. If the profits of Exxon and Chevron are the consequence of policy and war and not of innovation, I'm borrowing some words from Thatcher, forgive me, from a couple of decades ago, then obviously you might make the case that there should be a windfall tax. Now, can't you make the same argument when it comes to the pharma companies, Pfizer, Moderna? When we had mandates in some places whereby people had to go and get those vaccines, aren't those profits the consequence of policy and a pandemic out of their control?
It's a great point, and it points to the politicization of the energy industry in a way that perhaps no other has seen.
Sure. When it comes to buybacks, look, I know there's the innovation argument, and we haven't got time for that. Of course that exists. But when it comes to buybacks, we're talking about Chevron. We're not talking about Apple.
Okay,
we're talking about margins. We're talking about Apple. Can we talk about Apple margins? They're huge.
The reason why we politicize this, though, is because of the backdrop of climate change and this concern, and that a lot of the energy companies themselves are coming out and saying they've got to reduce emissions. So the question is, how do you get there? And just to jawbone these companies lower didn't work, at least not when there was some sort of disruption in the oil supplies.
But I'm far more cynical. It's about getting re-elected. It's about votes.
Right, it's political.
This is how you speak to people. And Anne-Marie nailed it a couple of weeks ago. I think it was last week when we talked about it. She said, John, you buy an iPhone once a year, you make a monthly payment, you don't really look at it. Oil at the gas pump, that's what's going to make the difference in the polls. And that's all it's really about.
Yeah, and that's what we've seen in terms of consumer spending as well.
We're going to get philosophical here and look at the broader oil policy. Regina Mayer joins us now, Global Head of Clients and Markets at KPMG. At Barely describes her hydrocarbon wisdom from Houston, Texas. Regina, I'm going to cut to the chase. Are we prepared for $100 a barrel oil?
Well, I think we've been there, right, Tom? So clearly we are prepared for it. I don't expect that we'll see that maybe in the second half of this year. We still have muted demand, but IEA is expecting that demand will grow to the highest level ever for 2023, nearly 102 million barrels per day. And while supply is still comfortably within the 5-year rolling average, what will happen when Russian supplies come off the market? What happens when Chinese demand spikes? What you talked about relative to the large traditional energy companies, their response to capital investment is going to be more muted because of the politicization that you just mentioned. So we're not going to have massive increases in supply, and we're still facing into significant hydrocarbon demand worldwide.
What do we do downstream? I think there's so much romance to the upstream debate, far less romance to downstream Houston. What about not in my backyard? And what do the big companies do about that? They're fighting massive blockage of setting up refinery, right?
Oh, absolutely. There's not in my backyard for wind farms, for solar farms, for all kinds of investments, natural gas exploration and development. And so what we're seeing, I was actually in Davos, so share some of the macro trends that I'm paying attention to. Clean energy for the first time in 2022, dollar for dollar matched fossil fuel energy. But that's not going to be enough to achieve the energy transition. It needs to get to 4-to-1. Now, notice I didn't say 4-to-0, I said 4-to-1. So we still need hydrocarbon investments, and we need massive investments in clean energy and new technologies. The other word of the day was friendshoring, because the realization is the components for hydrogen investments, the electrolyzers, the solar panels, the wind turbines, a lot of that comes from China, rare earth minerals. So how do we create new supply chains to deliver the energy that we need from friendly parts of the world with a diversification strategy? And it's not just about oil. the weaponization of renewable components, politicization of all types of forms of energy, not just oil, will become a big part of the policy and the calculus that nations will have to address.
Regina, let's build on that with the question of diesel in Europe right now. There have been a lot of stockpiles of diesel ahead of a new sanction on diesel of refined Russian oil. At what point does that become a concern? Because there hasn't been enough friendshoring when it comes to diesel imports, in particular to Germany.
Well, for sure, those are some of the vulnerabilities that the war in Ukraine has exposed to the global supply chains. I'm hopeful that because we're aware and we're managing within the European continent in advance, it'll be like the success story that we have for natural gas. That is an economic success story that we don't often talk about. The European natural gas prices in September of last year were $3.50 per terawatt hour, or the way that they calculate it. It's down to 60/70, significant drop. Henry Hub is below $3 when it was at $10 in its 52-week high. I'm expecting that the European Union will pivot as successfully as they did for natural gas with diesel, and it will be part of their overall strategy as they wean themselves off of fossil fuels sooner rather than later.
Hey, Regina, this was great to catch up, as always. Regina Mayer there of KPMG. You know what? I can't believe it's almost been a year since this war started.
I think a lot of people can't believe it.
Isn't it just amazing?
It's horrific. It's
Terrible.
horrific because there's no sense of it ending. And that's what I'm really concerned about. There was a column that I was reading by a former general talking about how, in some ways, the U.S. is escalating this with respect to some of the weaponry that they're sending over because they're kind of calling Vladimir Putin's bluff that he isn't going to necessarily escalate in some sort of nuclear way. People are not worried about that in the same way. But what's the risk of this just dragging on?
Lisa, what happened to the conversation about only sending defensive equipment and being worried about escalating things? What happened to that?
It went away, which is the reason why I think it's quite interesting. This sort of question of escalation isn't more in the forefront because essentially now they're just saying, well, maybe fighter jets is a bit of an escalation, but other things not so much. So you're right. People aren't talking about that because people don't believe that the nuclear threat really is as present as it was a bit ago.
The war continues. This certainly, though, Tom, not the winter that many Europeans feared as a consequence.
Oh, yeah. Well, big drop. You look at a gallon of gas in the United States, and again, granted, it's not Europe and it's not the prices, John, you grew up with. But starting in February a year ago and the war and the huge spike up, we went from roughly $3.55, spiked up to $4.20, and then went higher to $5.02, and we've come right back down to where we were at the beginning of the war. To me, it's a behavioral thing. Regina was just on. She's a Cornell grad. And I remember in the 70s where you really thought about driving across town because it was such a shock what a gallon of gas is. And I'm fascinated if we go back to $4 a gallon or $5 a gallon, do we get the same behavior again that we knew back then?
Well, we did see that. And I think that was the takeaway from what we saw last year. There was demand destruction once you got to the $5 mark. I mean, yes, there was the SPR release, there was that response, but you also saw demand go down. And is that going to create some sort of ceiling to how high those prices can essentially go?
We went from 130 intraday was the high print on Brent in early March. 130.
I did not know that.
Yeah.
We got up to 130 on Brent.
Got down to 130,
I did not know that.
The low about 70. So somewhere in the high 70s this morning, Tom. And there are some calls, Jeff Curry and others, looking for triple-digit crude again this year.
We've been China-free, Pacific Rim-free. You get demand out of Indonesia. What does that do?
Things change, clearly.
Pros say up.
Liz Young's going to join us shortly over at SoFi, counting you down to a Fed decision. This is Bloomberg.
The world is in a much better place today than it was 4 or 5 months ago. A lot of the apocalyptic scenarios have gone out the window.
It's a pretty mixed picture. The inflation picture is very clear, but the growth picture is not as negative as it was 4 or 5 months ago.
Clearly, the China reopening story is the big narrative going on right now in markets.
Expectations were so low that it just put risk reward to the upside.
The biggest risk to markets is that we don't get a recession in 2023. The wage growth stays high.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A 14-hour day. We greet you this morning on radio and television and move on to the Fed decision this afternoon with Mike McKee's leadership. John Ferro, McKee in that press conference. Anything can happen.
Financial conditions, easy, front and centre. That's the headline for us. We ended January, Tom, with the easiest financial conditions going back to last February. Is that a problem for Chairman Powell?
Yes.
We're going to find out in this news conference.
And also, we talked to Dominic Constamere starting off our coverage this morning, and he made clear he reaffirms this edge of super restrictive because inflation's coming in.
Is it still too early to tee up a pause? A lot of people think maybe that pause is just around the corner, Tom. In the statement, there is this quote, ongoing increases. Will that be in the statement this time around? If you really want to get in the weeds of all of this, that's where the focus for the Mike McKees of this world will be. In the statement, does that language change?
Or in the idea of cumulative, which is, I believe, not in the statement, but that's the same idea of the effect meeting to meeting.
It's in the official communication of the Federal Reserve. I think there was an argument that Vice Chair Braided maybe put it in there, Tom, in that statement. Where is the damage? Where is the damage right now? Because it's not in the labour market at 3.5% unemployment and claims at 186,000.
I'm going to go, Lisa, as simple as I can. Liz Ann Saunders pounding the table that she's following of the mix of everything today, housing dynamics. What does the chairman say about the impact of housing? What did you call it? Service sector? There's some phrase for the new service sector series.
You mean the rolling recession, the sort of question of the
core service?
Supercore. Supercore. Yeah, that's exactly it.
Supercore. That'll come up in the press conference.
I was in Minute Band in high school called Supercore. No, but in all seriousness, there is this issue of what people are focused on, but also what the Fed wants to do. And I like that you guys both were talking about that 8-minute speech back in Jackson Hole. I think that today, the way that he could win is by giving a very short speech and then saying nothing. Because right now, there's really nothing that he could say that's going to get the market to comply with him, and he isn't going to be able to do anything good if he signals some sort of pause or some sort of easing in financial conditions.
Lisa, John outlined it earlier. The data dump between now and Friday at 8:32 is extraordinary, including earnings.
So then why should he say anything? Why not just say, look, we're still doing the same thing. I'm looking at the data.
Tough to do in the news conference.
Right, people are going to ask.
Plus, he's actually not very good at doing that.
Correct. He always ends up saying something. What do you think, though, is going to be the main question that he's going to get that could potentially trigger some sort of reaction? I'm thinking perhaps it is about how concerned he is about the easing in financial conditions. Does that bother him?
Number one. Absolutely. I couldn't agree more. That is the question. And the spread between them and the market off the back of that, because of that. How do they resolve that? But the problem is, Lisa, they can't resolve that today. They can't resolve that today with a 25 basis point hike downshifting again.
But they could say, we are bothered by the rally. We don't like what the market has done. This goes against what we're trying to accomplish. That could potentially move the markets.
I just flat out disagree with that. I just don't think they look at the markets like that. They look at it as a sum total, which shows within the Bloomberg Financial Conditions Index shocking accommodation. I mean, the market's part of that.
I think ultimately you're both on the same page. You pose the question like this, and a journalist will do it. Have we seen an unwarranted easing of financial conditions in the last couple of months since the last Fed meeting? And you give him the floor. He knows this question's coming. So how he answers it, you can read a lot into it. He knows this is coming. He woke up this morning, looked in the mirror and practiced it. Like, this question is so obviously coming.
No, he'll have a written out statement.
Totally right. He's doing it right now.
Exactly.
He's going to have a written out statement about the social impact on a huge part of America that is flat on their back. I mean, there's a huge body of America. They're looking at people in bow ties, navel gazing recession, and they're going, are you kidding me? We've been living one.
To be clear, perhaps people are listening to that in the general population because that will be perhaps a headline. The markets don't care what he has to say about that. Let's be honest.
Yes.
They do not care. They are looking for what he's going to say about what he's going to raise rates and how much he is bothered by the easing in financial conditions.
We're going to dive into a spirited discussion on this, but we need a data check. John, I'm going to start with the accommodation on standard deviation, positive 0.326. That's not a Powell-friendly data point.
Stocks this morning lower, soft and negative, down about 0.25%, but on the year to date, in the month of January, absolutely flying up 6% on the S&P, on the Nasdaq up 10 in Europe. Even more so in some places around Europe, Tom, and beyond over in China. Just a massive rally. And we have to talk about China too. I'd love to hear about China in the news conference with Chairman Powell a little bit later, how he thinks about demand picking up. Maybe he thinks we get some inflation imported out of China as well. I'd be interested to see how he frames the China reopening, because, Tom, you cannot make a call on the economic data without a decent idea, for the global economy anyway, without a decent idea of how this China reopening
I want to go to Richard Clarida and say, off the new Blanchard effort, there are these other factors out there like demographics, technology, and such. And how blind is the Fed flying? How far are they from some conventional monetary
Do we get
theory?
that dark room analogy again? We're in a dark room, we've got to move slowly.
Yeah, probably.
You know,
that's what,
Socrates
that what we're getting.
Socrates caves are looking
all of
at
that
the
stuff.
reflection. Yeah, okay.
Let's get some clarity. Liz Young joins us now. She's been on fire on Twitter. She's been a real value add out on Elon Musk's Twitter. She's head of investment strategy at SoFi and joins us now. You saved the best part, Liz, for the bottom of your research note. I love it. If it looks like a duck, walks like a duck, quacks like a duck, you're saying, look, this is not flamingo, it's not ostrich, it's a duck, and we're going to slow down. What is the evidence you see that there's a duck out there that says slow down?
Yeah, well, good morning, everybody. I'm glad to be here. So when you talked about it actually earlier in the hour just now, what are the indicators that are telling us things are actually getting worse? If you look at the leading indicators, or the things that we usually look to give us a signal that things are getting worse and not better, most of the leading indicators, if not all, including the Treasury market, are telling us that things are getting worse. So if you look at things like the leading economic index and its change over a 6-month period, right now that 6-month change is negative 8.2%. That level has never gotten below negative 3% without a recession to follow. You look at the yield curve inversions, not just the 2s, 10s anymore. We're looking at a 3-month 10-year inversion, the near-term forward spread, which is the Fed's indication of inversion, all inverted deeply and for a long period of time. So these are no longer questionable inversions. Right. And then things like capacity utilization moving down for 3 months in a row, that usually precedes a recession as well. So they're indicators that we can't ignore, but I recognize that some things out there still contradict that, and there are reasons for people to stay bullish, and they're excited about this rally that we've seen in January.
I mean, Liz, I see this, and I see the theory, and it's a tight linkage here, and it's also known, of course, at NBER and in JSTOR as the Abramo-Young theory. There's no question about that. It's a little bit of caution, to say the least. How does the chairman adapt to the Abramo-Young theory today in the key bright lights of the press conference?
So here's the thing about these press conferences. Jerome Powell has not really changed his tune at all, yet the market, every single time we lead up to one of these press conferences, challenges him and says, we're sort of listening, but we're not entirely listening. So prove to us again that we should listen to what you're saying. The hiking cycle is maturing. There is no question about that. They are definitely closer to the end of it than to the beginning of it. But here's the thing about a rate hike cycle. It usually indicates that we are late cycle in the business cycle, right? That we're in the late part of the business cycle. And when we get towards the end of the rate hike cycle, that usually means that we're at the beginning of the economic cycle turning down. So this doesn't always happen at the same time. It happens in a sequence. Rate hikes, as we all know, take a while to bake into the economic data. So we're just now seeing some of that come through. We've obviously heard headlines in certain sectors. I think that there already is a recession in certain sectors of the economy, particularly in tech and in financials. So it's not something that we can deny and say everything's fine. The labor market is still strong. Yes, that's true, but only in the data that we know of. And that data is lagging by about 6 months when you look at some of the downturns that started to happen last summer and fall.
Putting the bond market aside, because perhaps the bond market is pricing in some of that slowdown, isn't the stock market disagreeing based on January's action?
Absolutely. And I think the stock market, this is what gets confusing for investors, self-included, right? You look at all of this conflicting data and say, one of them's going to be wrong, but one of them's probably going to be right. So the stock market, I think in January, traded on a number of different things. Some of them were technical. Some of them were the opposite of what happened at the end of last year. And we very quickly forgot that December was quite painful in both the NASDAQ and the S&P. So as we got really excited about a 6% rally in the S&P in January, people seem to forget that it was down 6% in December. The NASDAQ was down 9% in December. So it's not as if we've suddenly got all of this new alpha generation. It's really just making up for the drawdown that we saw at the end of last year. But there were some other things that came into play. Inflation is moving in the right direction. Goods inflation probably moves to all-out deflation this year. And that is a good thing for consumers, and that is a good thing for input costs. The concern now is that at what point does the inflation drop actually get stuck? Will it get stuck at a level that's higher than what the Fed is comfortable with? And will it get stuck at a level that keeps the Fed hawkish or keeps rates high? How long can businesses and the economy sustain through that environment? And I think that's really the biggest risk for the rest of 2023.
It's the what if. What if we end up at 4 and we get stuck there, to Liz's point, Tom? Yep. It's a great final point. Liz, thank you. Liz Young there of SoFi, ahead of that Fed decision and ahead of the data. ADP report, 4 or 5 minutes away, Tom. The employment change, looking for 180,000 in our survey. The previous number, 235. That's the appetizer for the main event. Payrolls Friday just around the corner. Looking for a payrolls number, 190,000 is the median estimate in our survey.
To me, that's
so far,
sit
190.
on that. 190 is the estimate?
Yep, down from 223 in the previous
people,
month.
I believe it's J.P. Morgan. I can stand corrected if I'm wrong. They say we need to go under 100,000 to show we're miles from that.
That's J.P. Morgan, Bank of America, and Morgan Stanley all say exactly that.
Do you want Andrew Hollenhorst and his estimate over at Citi?
Please.
Yeah.
305,000.
No. Really?
They're going at 305. They think that we get a real bounce back in the January labour market data. Do you want the low? Intesa. Intesa Sao Paulo out of Italy, taking a guess. Throwing a dart with a blindfold on. That's everyone. That's not a jab.
50,000.
The Italian banks, they're looking for 130. So there's your range. At the moment, at least, 130 to 305. That's your low and your high.
Font of information.
Your medium, 190.
Can you imagine?
Futures.
North of 300.
1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Policymakers at the Federal Reserve are expected to moderate interest rate increases again. The Fed is wrapping up its two-day meeting today. Chair Jerome Powell likely to keep further rate hikes on the table while leaning against bets the central bank will cut later this year. President Biden and House Speaker Kevin McCarthy meet today with the upcoming debt limit in the balance. House Republicans are demanding spending cuts. The president said he's open to fiscal reform but won't negotiate over the borrowing cap. Failure to raise the debt ceiling could lead to a default. Inflation in the Eurozone slowed down more than expected in January. Last month's reading came in at 8.5%. Now that suggests there will be a more heated debate to come at the European Central Bank over how much more interest rates should rise. The UK has been hit by its most severe day of strikes in more than a decade. As many as 475,000 union members are on strike today, closing schools and crippling the nation's rail network. They're demanding pay hikes to offset the cost of living crisis. And J.P. Morgan Chase is planning to open a digital bank in Germany. That will create a launchpad for the largest U.S. bank to expand in Europe. Bloomberg's learned the German bank will open late next year or early 2025. J.P. Morgan plans to target other EU countries after that. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Jay Powell hates surprises and likes to stay on script. The surprise part, not possible. Everyone said 25 basis points, so there'll be no shock. I think he's going to have to put a hawkish tone, and that's the staying on script. Pause is off the table. Nobody plans to pause.
Chairman Powell just around the corner. That was Vincent Reinhart, the chief macro economist and strategist over at Dreyfus and Mellon. Equity futures down 0.2%. Some data just moments ago. Let's get you that economic data. We can join Mike McKee down in DC. Hey, Mike.
Hey, John. Yeah, well, if Jay Powell hates surprises, I got a bad one for him here. 106,000 jobs created during the month of January, according to ADP. Now, the ADP report doesn't have a great track record. It doesn't have a long track record either, since they did it last year. However, this is significantly lower than the 180,000 that had been forecast for this indicator. ADP basically blames the weather. The blizzards in the Midwest during the month of January and the big floods in California kept people off the job. Now, it's interesting because ADP looks at the whole month of employment, whereas the Labor Department looks at the pay period containing the 12th of the month. So ADP shouldn't have as much of a weather impact as the BLS does. So it does raise some questions about what we're going to see on Friday. The official consensus forecast for Bloomberg is 190,000 jobs for the BLS report on Friday. Goods producing jobs were the big losers, which would fit with a story about the weather, with 24,000 construction jobs going away. Manufacturing increased by 23,000, according to ADP. And the only area of the country that lost jobs, the Midwest, 40,000 jobs fewer. And again, that could be the weather. So if the ADP is to be believed, January might have been a softer hiring month. But because they're talking about weather, guys, it may not be something that fits the pattern of, well, the Fed is slowing the economy.
And Marty Key, thank you. Have you got some breaking news yourself, Bramo? Tom Brady.
Yeah. No, I wasn't paying attention to that at all. Yeah, Tom Brady just announced that he's retiring in a video. So
again,
perhaps,
just to be clear, again.
Yeah, again. So he did before, but now evidently it's not being pressured by anybody in his household, it sounds like. I'm not going to get into any of that. But
well, you just did.
Oh, but please, continue.
We'll just move on,
Continue.
please. Let's just go on. Let's talk about the ADP. Let's talk about the market response to it.
Gave up Giselle for that season with the Bucks.
But that's exactly what I was saying, you know? I assume there's more to it.
Can I just
we can never get
here,
inside the bedroom.
I think she's doing an interview with Vanity Fair soon. So I heard.
You're tracking it just as closely.
And we'll get this out, folks. I'm looking at the wonderful video of Brady in a T-shirt. And Mike McKee is with us, who's really into the NFL. The Broncos had a great year. Mike McKee, he looks exactly like the kid out of Michigan nobody believed in a million years ago.
Well, he has worked very hard to stay in shape, which is why he could keep playing at 45 years old. I think he looks a lot better than you or I, Tom.
Got
Maybe
that
not
right.
as good as Bramo and John.
No, well, Bramo's got chiseled. I mean,
but there was a lot of speculation he'd keep playing because he's still in good shape.
I mean, there it is, and we'll get the video out. There'll be tons of coverage on this.
I still think there's a chance.
Can I just say, hold on a second. The fact that we're talking about Tom Brady instead of ADP is actually telling. I mean, on one hand, because it shows the lack of importance that a lot of people put on ADP, even though we're talking about jobs data that's coming out, that's all important, coming out on Friday.
We are giving the ADP report the respect it deserves.
Wow, that's harsh.
That was just, just a statement as fact. It's amazing that everyone looks at the ADP report and they're like, I don't care about it, and then they trade on it in the bond market. You have to lower by 2 basis points.
I'm going to defend ADP that they're figuring it out, and they're going, Mike McKee, help me here. They're going back to their countable paycheck ability and automatic data processing. They're not doing economics now. They're really looking at the data. What does the data say, Mike?
Well, the data says that we're seeing a slowdown in hiring, and it gets down. You were talking just before the break. Gets down to about that 100,000 level, which would be the replacement level, the level of jobs you need created each month to absorb new entrants. But if this is just weather, then one would expect a snapback in February, and so it's hard to divine whether it's telling us anything about the future course of the economy. Or not. You're right. They do say they're trying to focus on how many jobs were created and not massage the numbers. Should mention they also do payroll now, and the people who stay on the job saw their pay increase 7.3% during the month. That doesn't show the kind of progress that the Fed would be looking for.
There is some indication from this data, even if it is distorted by weather, in terms of the services bifurcation with the manufacturing side of things. And you have seen that divergence continue. Has there been any precedent for this, a sort of rolling recession in manufacturing without the rest of the economy following on? And I say that ahead of the ISM here at 10 a.m.
Yeah, you go back to 2015-16, there was definitely a manufacturing recession in the U.S., particularly in the oil patch. And it didn't translate into the rest of the economy, but we did see a significant slowdown at that time. So it has happened before. And it is interesting that so far the Fed's raised interest rates 450 basis points, and unemployment has actually only gone down.
Let's stay on theme. Tom Brady, quits rate later. Mike, in all seriousness, I love that data point. When we get the JOLTS report, it's the quits rate, because ultimately, if you feel confident about the economy we're in, you quit your job because you think we can get another one. And Mike, that quits rate actually picked up in the last month. Are you looking for the same again?
Well, it's hard to say because it was a holiday month. When you're talking about December, you're talking about periods when people may not be focused on their job as much, but it'll be interesting to see. The other thing we want to see is the job openings number, because, of course, Jay Powell has hung the Fed's strategy on that. The idea that there are so many open jobs in the country that we don't have to have a big rise in unemployment or necessarily a recession to bring down inflation. People can just get the open jobs that there are.
Mike McKee, wonderful, as always. Looking ahead to payrolls on
Nice
Friday.
Brady analysis
And the
there,
data a little bit later.
McKinney's gifted.
The ADP report, 106,000, Tom. The estimate, 180. The previous number, a revised 253.
With his prestige, a year ago, I believe he darkened the door at Manchester United, and there was this huge uproar. I mean, and particularly after his Bitcoin debacle, which I have no personal knowledge on, but this is a guy that needs to attach himself to the tots. I mean,
you think so?
Yeah, him and Harry Kane bonding, loving kisses, and taking equity interest.
No, I think there's a relationship between the Bucks and Manchester United and the Glaziers and all that
Yeah,
stuff.
I get all that, but I mean, this is
What would
something.
you like to see him do for Spurs?
Just show them the
Sit with him
excellence.
in the
Look, he's the
sidelines
most
and eat
underrated.
pies.
This guy was the most I remember clearly. Who is this guy? No one cared about this guy from Michigan. And in the pantheon of this, in the persistency of his excellence, there's no one.
Do you think he's actually retired?
Yes.
You think this is the one?
In the video, yeah.
I knew that that's what you were hinting at when you said, I love the quits rate, because it should suggest confidence that you can get another job
Please, you read
that's
between the lines.
equally high paying. So I looked at Indeed.com for the highest paying sports jobs. He could become a sports editor. He could make $36,000 a year.
That's the highest paid job.
Baseball coach, $39,000 a year. No, in all seriousness.
To be a baseball coach, you only get that much. Where's
I think
that?
she's
That
thinking
says,
Little League.
I think that this is
Babe Ruth,
probably,
ninth grade.
That's not
Like, this is-
Yankees money.
I'm guessing this is not Yankees sports reporter, $40,000 a year. Just some suggestions for Tom Brady.
Okay, that you think Tom Brady's going to take one of those jobs? Hasn't he got a TV gig lined up at Fox?
I'm sure.
With some serious money.
I have no doubt.
Tom, have you seen that contract?
Yeah.
We're talking like real money.
Yeah.
Never mind
I just-
40,000,
come on.
hundreds of millions.
Harry Kane,
I'm
come
sure.
on. Harry Kane worships Tom Brady. He really patterned his career.
That's actually true.
By his thing.
He is a big fan.
You bring Brady over. You reach, and this is with Mr. Conte,
He's still trying
very
to make this
sick with
happen.
gallbladder surgery today. But
He
I mean,
gets
come on,
consulting
Brady
fees.
can add a certain luster there. You could get Brady, Gareth, the whole group there to reignite the, what are they, fifth place tots?
Okay. I've got the control room in my ear saying we're losing audience by the second. So I just want to come
It's
back.
a lovely video. I'm sorry. It's a lovely video.
Coming up in the next hour on the markets, not on the NFL or Tom Brady, Bob Michael of JP Morgan, Kathy Jones of Charles Schwab.
Oh, very nice.
On the equity market, Mike Wilson of Morgan Stanley, Chris Harvey of Wells Fargo. That's your next 60 minutes on Bloomberg
Jerome
TV.
Powell may get a question today on Brady.
On Brady?
Yeah, sure. Why not?
Okay. What
It's
do
a
you think he's
big,
going to say?
John, for America, this is a big deal.
For America.
For America, this is a big deal. This may not be a big deal for you, but Lisa
hang on a
Abramowicz
second.
fully
Why do you
briefed on
think
Brady.
he's leaving now?
When Mike McKee broke the number and we came back...
You did nice. You finessed it.
I went straight to Brady.
Yeah, you
straight
did.
to Brady.
Yeah, you did.
You know,
And then
I,
said that.
I understand the magnitude of the moment. I get it. I really do.
So you're going to leave now? You're gonna leave.
There's a part of me that just doesn't believe he's retired. I don't know.
I know. I think that you're probably right.
Give it a few months.
I think he's retired this
San
time.
Francisco.
No.
No?
I don't know.
All right.
Bloomberg Surveillance on Fed Day. Please join us this afternoon. We lead with the former Vice Chairman, Richard Clarida. Some good guests. Jeffrey Rosenberg scheduled to be with us, among other worthies. Diane Swank, we are thrilled, will be with us today. Right now, Lisa Abramowicz and Tom Keene, as John Farrell prepares for a middle and 9 o'clock hour on television as well. Right now, we're going to go with futures negative 11, a bit of a roll-off off the shock ADP data. to Michael McKee on the obscurity of his data world and the debt ceiling. Michael, what is odd at 8:30 Wall Street time?
Well, Tom, we have the latest refunding decisions from the U.S. Treasury Department, and the extraordinary measures that Treasury is taking to stay under the debt ceiling are enabling them to sell as much in terms of refunding bonds this quarter as they did in the prior quarter. The auction sizes are unchanged. They're going to sell $96 billion worth of securities next week. $67.1 billion will be to refund maturing securities, and $28.9 billion in new cash. The only way they could do that is because they're taking the extraordinary measures to stay under the debt ceiling. Auction sizes, as I mentioned, unchanged from the prior quarter, and they say it is unlikely that the debt limit will be breached before early June, but expect variability in bill and cash management bill sizes. Treasury is basically going to say, as we get closer to the debt ceiling, we're going to sell very short-term securities so they don't run into a debt ceiling problem.
Mike, what's the so what here in terms of who buys that debt? Is it U.S. institutions? Is it the American public? Or is it foreign participants?
Well, it's a mixture of all of those, and we've seen the central banks go up and down, and we have also seen the primary dealers go up and down in terms of who's buying what. So far, no indication that either the debt ceiling or any of the political problems that we've had in the United States are causing people to rethink. But we are watching countries like China to see if indeed they might cut back on their purchases of U.S. Treasuries. And then there's going to be a real question when Japan gets to the stage of deciding what to do about yield curve control. If yields go up in Japan, we might see a lot fewer Treasury purchases from the Japanese as they switch to their own country because they can get a better return. I did want to mention, Tom, in terms of the news of the day and jobs, Tom Brady, you were talking about, is going to Fox. At least he has a contract to go to Fox to be their lead analyst for $375 million over 10 years. So he is not a retiree. He's a job switcher.
Okay.
And I'm wondering if that's going to affect the job salary sizes because he's switching over.
Fantastic analysis. Michael McKee, I love it. He's talking about the denomination of what we've seen with respect to Tom Brady leaving, and it's not leaving, it's just switching. I do want to get a sense, Michael, because Tom asked this question basically, why do we care about this sort of granular inside baseball type of machinations? There is a question about whether the debt ceiling and the debate around that is going to affect the roll-off of the Fed's balance sheet, their ability to continue selling debt as they go through this year. What's the latest on that?
Well, the Fed hasn't commented, but Jay Powell will probably no doubt be asked about that this afternoon. If the debt ceiling is binding and we get to a situation where there's not enough issuance out there, the Fed could speed up sales from its balance sheet to try to provide more liquidity to the bond market, or they could just simply start buying bonds. They have said in the past they won't do that. They don't want to get in the middle of a fight between the administration and Congress. But of course, if the market seized up, they would feel obligated to do something.
Michael McKee, thank you so much. And we look forward to your question to the chairman this afternoon on the career, the life of Tom Brady. Now joining us, Jerome Schneider, who's better than good in the short-term space with PIMCO as well. No, Jerome, I'm not going to ask you about Tom Brady, but I am going to ask you what we've observed through the morning. What a January bounce. I guess you could take 4, 5, 6%. And I know, Jerome, you're sitting with your Bloomberg and your Monroe Trader annualizing that out as well. What's the now what for you after a January pop?
Yeah, in reality, what used to be just a handful of basis points is pretty substantial. And you're right, Tom, the annualized returns you have in a single month now add up to something, for cash, that's something in the realm of 4.5% to 6%, depending upon your strategy. That's an important factor to consider when you look at the landscape right now that's punctuated with economic uncertainty, potential for volatility, and we're at a crossroads right now where clearly the market is at an impasse with the Federal Reserve and where they're going. And so that's going to probably be reconciled over the next couple of weeks, months, and as it is, it doesn't necessarily portray to be a smooth ride. So we do still find value within that front end of the yield space, within the global bond world. However, I think really the question is not necessarily where to be on the yield curve, but more importantly, it's a discussion of how much to allocate to fixed income in general, given the recalibrations we've seen.
And Jerome, what's so important here is OBE, where you're overcome by events. And here, Jerome, and I'm speaking as a total hack, people in the mid-maturity decide they want to enter the Jerome Schneider space, and you get price up, yield down, where it's no fun for you. Are you going to be overwhelmed by people running, dashing to short term?
Well, there's actually pretty much a tremendous supply of that, and I think it's sort of met on two folds. Number one, you have of course, people looking for moving from lower yielding investments now that they're aware that there is attractive options in cash, but there's also significant opportunities that persist, and it's really typically outside the traditional landscape of money market funds and T-bills. It's more in buying short-dated asset-backed securities, high-quality commercial paper, things that really have self-liquidating features, but yet remain fairly insulated to where we are in the global economic cycle. That's the key. But I do think that there is an overall focus right now where people have shunned for more than the past decade an over-allocation to bonds, and that really gets to the point right now of instead of a discussion of where on the yield curve to be, despite the discussions of where we are with the Fed today, it's more about how do you want to create a more balanced portfolio given the yield enhancement that we can see for portfolio performance more broadly.
The shift in tone, Jerome, that you have right now is telling to me because you were one of the most popular people, I'm sure, in the investment world about 6 months ago when everyone was flooding to cash. And it was all about the appeal of cash as an income-producing instrument. Now it's fixed income is an appealing alternative to other assets, perhaps in a way that they haven't been. Does that indicate that people are moving out of cash at a really rapid pace and going into other either denominations of credit or equities?
Well, not necessarily. And I think what is still prevalent in people's mind is sort of getting a little bit stung by the third rail of volatility within the broader marketplace. People obviously don't really dismiss what happened in 2022 so quickly. And more importantly, when they see periods of risk off, there is a mindset now, even in the retail investor, to be very focused on how much volatility your portfolio is going to produce during those uncertain times. And so while people might seem opportunistic or perhaps see a softer landing given the real data we've seen over the recent past, the reality is you're not seeing that risk appetite being as pervasive as it once was, specifically because that inciting action was driven by extremely low yields. That is a factor that's recalibrated people's expectations to create a more balanced approach to how they handle risk. And again, focusing on the volatility within their portfolios, whether institutional investors or retail investors for that matter.
So if flows continued, that you have observed at least, into your funds and into the fixed income space at the same clip that they did, say, a month or 2 months ago?
Yeah, no, I think what we're seeing is sort of a pause right after the year end. People are really sort of accepting the fact that these higher yields are still here to stay. They're taking that initial step into perhaps money market funds. Some T-bill supply has come, and that's sort of being met with some initial demands. But we are seeing people utilize this as a more strategic approach. Front-dated fixed income, low duration type of strategies, things really within the 0 to 5 year part of the yield curve are really sort of giving people an opportune set to create that balance. What I think is important right now is there's a natural tension within the market, a tension which is that the market is clearly trying to forecast and get ahead of the prospective Fed cuts that might come from a historical perspective. The market is fixated that comes. But that's a probability-based event. And what I mean by that is that there's an uncertain action that when you look at market pricing says there's a certain probability that it will be assigned to it. It doesn't mean with 100% certainty there's cuts on the way at all. It's just a probability that it would happen. What's more important, though, is that the Federal Reserve is operating from the next chapter of that playbook from a historical perspective. Sure. And they're fully in mind that there's lasting damage from inflation. What it means for the investor is that there is going to be some reconciliation, and that reconciliation isn't necessarily as painless as people might portray, even if we do get that soft landing, Tom.
Jerome, Lisa from Fargo emails in. Thanks for watching, Lisa. And she says, does a guy like Jerome Schneider care about the debt ceiling? Do you care?
Yeah. Of course we care. Of course we care. But it's a little bit too early. It's the prelude to the actual act, and not that we're forecasting any default situation, although that is a potentially remote situation that we have to be prepared for. This is not really a discussion for today or tomorrow or even March or April. It's well into the summer. And I think that we have a good playbook on how it happens. For our point of view, where we say right now is really focused not obviously stay on the Fed today, but more over the next 6 weeks, where we're going to be getting, frankly, more important messaging from the Fed in terms of the summary of economic projections in March. And so the march toward March is really where we can see a little bit more definitive posturing in terms of the broader market impacts. The debt ceiling is not something du jour that we have to worry about, perhaps being trumped by the Tom Brady news.
Jerome Schneider, thank you so much for that comment on Mr. Brady. He is with PIMCO.
And the other comments on bonds, come on.
No, but Lisa, I think this is really, really important. We're seeing a bond market reaction. 4.19%, 2-year comes in a bit, 10-year comes in with a vengeance, 3.47. But what I'm really noting here is some substantial inversion over the last 2 days. Round it down, negative 73 basis points with a real yield coming in every more. And I look at the sum, and the one outcome no one's expecting is 2.99%. 3.99% 2-year yield. Nobody's looking for price up, yield down.
Well, in terms of actually pricing in more substantial rate cuts within the next year or so by the Federal Reserve at a time when they're saying no. What I'm struggling with here, and something that we've heard from a lot of the guests, is this dissonance between a bond market that is pricing in that softening and expecting that the Fed won't have to do that much, and a stock market that's not on the same page despite earnings, right? I mean, you could say we're just bouncing back a little bit after the sell-offs of last year, but at what point does that divergence start to create a little more discomfort among strategists?
And another thing, and you've just brought this up, this from Bloomberg reporting right now that Blackstone's real estate trust, at least it was on, has hit their monthly redemption limit in January. And I mean, that's a continuing story there of housing upset.
Well, and what has been priced in versus not, given that it's not a very liquid market.
For Global Wall Street, please stay tuned. Professor Abby Joseph Cohen of Columbia Business School. Good morning. This is Bloomberg Surveillance this morning and this afternoon.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers plan to hammer home the message that their work in fighting inflation isn't done. They're expected to raise interest rates by 25 basis points at the end of their 2-day meeting today. Chair Jerome Powell is likely to keep further rate hikes on the table while leaning against bets the Fed will cut later this year. Former South Carolina Governor Nikki Haley plans to announce she's running for president. She would become the first Republican to officially challenge her boss for the nomination. Haley was ambassador to the United Nations under Donald Trump. Meanwhile, the former president raised less than $10 million after he announced that he's running, and that's seen as a disappointing haul. The White House is taking aim at high credit card fees and mobile app stores. The Consumer Financial Protection Bureau will formally propose a rule to cap late payment credit card fees at $8 from an average now of roughly $30. Meanwhile, the Biden administration wants Congress to open up mobile app stores to greater competition. Thieves stole a record $3.8 billion worth of cryptocurrency in 2022. That's according to blockchain research firm Chain Analysis. Its report says that hackers linked to North Korea stole an estimated $1.7 billion last year, more than 4 times as much in 2021. And as you've heard here on Surveillance, pro football quarterback Tom Brady says he's retiring from the NFL, this time for good. In 21 seasons in the league, Brady won 7 Super Bowl championships, 6 for New England and 1 for Tampa Bay. Brady announced his retirement last year, too, but a few weeks later, he returned. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We've actually got a house view that's a little bit dovish relative to markets. Like everybody, we expect 25 basis points at this meeting, but after that, we think they're going to be done at the Fed. The only way that happens, but we think it is the path that will happen, is if we get farm payrolls coming down well below 200 and looking like they're going to 100,000 and in fact below 100,000.
The nuances of Ellen Zentner and Seth Carpenter. They're Dr. Carpenter, the chief global economist at Morgan Stanley, on the parlor game we're going to see today. Lisa, to me, what's going to be fascinating here is what Powell reads off script. There's so many sensitivities. Does literally every question, does he look down and read that silly scripting, pretending he's not reading it? I mean, that's the, on radio, for those of you on radio,
so true.
It's hilarious
so
when, and Lagarde does the same thing. I mean, I'm not picking on anybody here, but, you know, the question, let me me answer that as best I can, and then they read off the script.
We have decided collectively as a group. No, but I really do want to hear what he has to say about financial conditions, how much he pushes back, and whether it does bother them or whether they're okay with it because the economic data is softening enough to give them comfort.
One of the great fears of academics on the island of Manhattan this year has been to audit Professor Cohen at Columbia Business School. Joining us now as she rockets out of a term into tests and grading, Abby Joseph Cohen, of course, a nodding acquaintance with Goldman Sachs and professor Columbia Business School. Are you enjoying it, Abby? I mean, is this like a whole new life for you where you're gonna be there till you're emeritus? I mean, is that where we're heading?
Good morning, Tom, and good morning, Lisa. I'm having a great time at Columbia. The students are absolutely wonderful. About half of them are from outside the United States, and they're all extraordinarily well prepared. Most of them have worked before they've come to business school, and so these are people who are really committed and focused on what they're doing.
Let us talk about a paper you did. I don't know if you dragged it out for your students and punished them, CFA Institute, where you brought some Greek philosophy to Columbia Business School. And what Aristotle suggested in your iconic paper is get off the wagon of believing every data point. Tell us what's suspect right now. What's the humility we and the chairman have to bring to scanning every tea leaf?
Fabulous question and a very timely one, Tom. Right now, I think there's so much focus on U.S. data among U.S. investors. We have to recognize that the Fed is also looking internationally, and they're looking at the trends there, both with regard to economic growth and inflation. And then, of course, there are the concerns about what happens to the data in China. People don't quite trust those data. And so when we turn our attention back to the U.S., it's our employment data. But today alone, we're going to be getting the JOLTS data, which will be a very important element of what we look at. And of course, the employment cost index information, which is critical. When I think about what I worry about most right now, in terms of too much instant analysis, it would be the company reports. We're in the middle of earnings reporting season. And what we know from history is that in periods when the market has been down, companies will take a look at those fourth quarter results and say, you know what? Let's take some reserves. Let's throw in the kitchen sink. It clears the slate and gives them a lower base from which to work for the subsequent year. So I wouldn't read too much into the fourth quarter results, particularly when they seem to be throwing in all kinds of disappointments that they knew about for a long time. And I'm much more focused on economic activity going forward.
Have we priced out free money from equity valuations, Abby?
To a very large extent. We saw that happening during the course of 2022, Lisa, when we saw PEs in general going down, but the segments of the market, not just in the United States, but outside as well, were basically the high beta, fast growing areas that really depended on low interest rates. For the low discount rate, it gave the valuation. So, we saw it here in technology stocks, other growth areas, but we also saw it in emerging markets, particularly in the first half of last year. And by the time we got to the third quarter, I think that investors were looking at this revaluation, let's call it the devaluation of some of these growth areas and saying there may be some opportunities there. It's one of the reasons we have seen some of these non-U.S. markets outperforming the U.S. market, even though our market has been doing quite well. And of course, we've now seen some movement back in to the fast growing companies here in the U.S.
When you teach this segment in history, talking about zero rates, even negative rates for more than a decade, at least in Europe, and the unwinding of it, ending with a whimper. Can you write the book that it was successful, that this economy extricated itself from these low rate policies without a financial collapse?
We don't know yet, but clearly it looks like we are moving in that direction, but we're not finished. And it's not just looking at the economy, it's also looking at financial products. And here I do have concerns because we don't yet know what the results were in 2022 for lots of the very leveraged products, including private equity. We don't quite know what the impact will be on the economy of the reduction in capital available available to venture investments and so on. And I also think that some active managers who were okay but not great, who levered up their results, so they turned a dime into a quarter as they reported to their clients. We don't yet know what the full extent of the damage is.
Abby, what I think is so important here, and it goes to the body of your work, we just all enjoyed the carnage of 2022, whether it was 60/40 or SPACs, you name it, all the stuff that was invented at Columbia Business School. Abby, we've all got to regroup, and the hallmark of Joseph Cohen analysis is you've got to be in the game. I want you to talk now to the people that are all cash or near all cash, or even in bonds away from the equity markets. Speak to them right now.
Well, many of the individual investors, of course, have to consider other things like their tax situation, their risk tolerance, and so on. All of my work, Tom, as you know, has been focused in on institutional investors. And I think that we have seen this revaluation of assets in 2022 that makes me far more comfortable than I was, say, 9 or 10 months ago. We're for bonds 15 to 18 months ago, when I thought bonds were incredibly overpriced, that is, yields were too low. And we've now seen a very significant change. The Fed, like everyone else, I assume, will be doing a small increase this year. But most of what they're going to be doing, I think, has now occurred. They might do a little bit more, but after we've already seen 6 extremely large rate increases, most of the damage has occurred to bonds. So that looks like there are opportunities.
Well, Abby, I'm running out of time.
And of course, the revaluation in equities makes them more appealing than they were a year ago.
I got to squeeze this in, Abby. It's so important. The risk-free rate is back. Taleb says we've got gravity back in the system. How do the zombie companies, the never-been profitable companies, weak free cash flow companies, how do they work out in 2023?
I think there will be failures. I also think that good private equity investors may see opportunities, but I also think that M&A activity, strategic M&A from successful companies, will be taking a look at some of these operating assets and figure out ways that they can acquire and improve the underlying margins. What I worry about in terms of going through the year really is the potential for the debt crisis, the debt ceiling crisis, to become real. And the reason I'm worried about it is I take a look at some of the people in the Republican Party who've publicly stated they think it's okay if the U.S. goes into default. That, to me, suggests a big problem. And the meeting I'll be watching today, in addition to the FOMC, is the meeting at the White House between President Biden and Speaker McCarthy.
Abby, thank you so much. Professor Joseph Cohen at the Columbia Business School. She's going into her grades. She's, I think, like Roach. Roach went to Yale. He's brutal. He gave out a couple C's, and there was basically a protest.
What she said there was fascinating on many fronts. This idea that we've already priced out free money in stocks, giving it a sort of more equal feel in terms of risk and reward and an ability to actually look at what companies are doing rather than just financial policy. But then on a broader scale, the question mark around some of the less liquid areas. And you mentioned that BlackRock real estate fund and this question of redemptions and what happens when you do start getting the same kind of reckoning in some of these less liquid areas.
I can't say enough how this return to a rate structure and rate regime affects everyone away from the obvious financial markets. I think it's...
And so we haven't seen it in every single one, and that was her point, and I think it's a really good one.
You ready for 1:30?
I am. We get to see each other again.
From Columbia, Professor Clardo will join us at 1:30 as well to begin a wonderful, wonderful set of hours. The Fed decides. Look for that this afternoon. We'll be speaking with Jerome Powell. Good morning.
No, he won't.